நேரா யூடியூப் தான். Let's start the lecture.
Yes, sir. Let me give you me.
No, I can't hear you. So, is there any formal introduction required?
Live started, sir.
Let's start the lecture.
Yes, sir. Let me give you.
No, I can't hear you. So.
Yes.
Friends, very good morning and welcome to this revision class recap session for your benefits for the coming examination number 2023 intermediate group 1 accounting. So what we're going to cover here is all the chapters other than accounting standards in a span of roughly around 2.5 hours, close to 3 hours time. I know you're all well geared for the examination, well prepared for the examination. So this is not to teach you something, just to, along with you, recap all those chapters, voluminous syllabus, very quick manner, so that it will help you in the coming days of preparation little more effectively. So, my dear friends, do not expect this class to be, I will tell you, like, when you're hearing this lecture, if you had different expectation, like something important to be discussed, important questions to be discussed, chapters that is going to come in the examination or questions that is going to come in the examination. Like that in CA, nothing is there. So important questions, important chapters, like that nothing is there. But always there is something common for all examination, is that a simple analysis of various examination papers and making small predictions and all. So if I were you, I used to make some predictions, but that doesn't mean that I expect only those questions, and if that doesn't come, I feel shocked or sad, etc. So simple prediction to focus where it should be more. So always it's a simple common sense only, not rocket science. The point is, whatever had come significantly in the previous examination will have less prominence in the coming exam, and whatever have not come in the previous exam will have more prominence. So on that basis, we will have little focused on to few areas, because 2.5 hours time, entire syllabus what we cover in 250 hours plus, accounting alone 250 hours we used to take in a regular session. So that is what we are going to cover in now 2.5 hours time. It is not getting like 50 overs match reducing to 20 over. It is like 5 over match. So there is no space left. So we may have to cover certain important areas from this analysis. It doesn't mean this is guaranteed. Predictions, astrology, seventh sense, nothing will work in CA exam. So, my dear friends, you know that we have 3 modules. From an ICAI modules perspective, we have 3 modules. Module 1 cover 3 chapters, and we have module 2, we have module 3. So in module 2, though we find that in the module they have given 5 chapters, I always consider as 6 chapters. And in module 3 also we have 6 chapters. Totally we have 15 chapters. And this module 1 is purely of accounting standard. So one is like introduction to accounting standard, like history and geography of accounting standard, how accounting standard issued, all those things and all, my dear friends. Then the relevance of accounting standard, applicability, level 1, level 2, level 3 enterprise, and so on. There is another thing called, yes, document called framework. Regularly 5-mark question from this particular topic framework, which is very simple to score, easy to score from this area, but people used to ignore this particular document. Then we have accounting standards. We have in group 1 8 accounting standards. So this is what group 1. So the relevance of this module is that regularly it comes for 25 marks and framework 5 marks. Generally no marks come from introduction level, and also around 30 marks, sometimes 25 marks total, or maximum 30 marks comes from module 1. So out of 100, no, out of 125, your paper will have 125 marks, from which you are supposed to attempt 100 marks. So just a brief introduction only before that. After that, I will move straight away into chapters. Okay. So just to get an idea of what you're going to face, etc. So 125 marks accounting paper from module 1, 25 marks minimum, and goes up to 30 marks maximum. Now the remaining 100 marks or 95 marks, my dear friends, comes from module 2, module 3. So generally somewhere either 50-50 or 55-45. So either from this 45, the other one 55, and so on. Like that only the weightage is getting normally added. So we are not going to discuss every chapter weightage, etc. And one thing is that though we say some important segments and all, it is only important problem areas of each chapters. It is not like this chapter will come, this chapter will not come. So institute question paper of late covers all the chapters. No chapters can be omitted. So you are supposed to have awareness, knowledge about all the chapters, also knowledge about all the segments, all the problem areas of all the chapters. But some problem area has got more significance from the examination perspective. That's all. Okay. So otherwise, you find that the question paper containing questions from all the chapters. In module number 2, my dear friends, though it is 5 chapters in study module, we normally consider 6 chapters. Final accounts or financial statement of companies, then cash flow statement. Then we have 2 redemption chapter, redemption of preference share capital, redemption of debenture. Then we have profit or loss prior to incorporation, bonus and rights issue, So in the study module, financial statement of companies and cash flow statements would have given in a single chapter. I always consider them as 2 different chapters. In the latest examination also, we had questions from both. That is the previous examination. We had questions from both. Financial statement of company, 10 marks. Cash flow statement, 10 marks. Like that, we had question. Then we have module 3, my dear friends, which again consists of 6 chapters. We have insurance claims, investment accounts, and there are several chapters we are studying for the last time in the CA intermediate level, because in the new syllabus, the syllabus completely revamped, and we are having more focus on accounting standards alone, exclusive accounting standard, and additionally 1 or 2 chapters extra. Many chapters has been removed. So maybe last time we are studying or going to be facing in the examination. Insurance claims, investment account, hire purchase, single entry, that is accounting from incomplete records, non-profit organization, accounting from incomplete records. Then we have branch and departmental accounts, like that. So because whether it is first day of 250 hours regular session, or it is some 60 hours crash course or 3 hours rapid revision, I always start with the syllabus. We need to have a focus of what we have in our hand, so that we can just knock off each one, tuck. So thereby, this is the broad outline of our content, what we are going to face in the examination. Okay. Here, we are not going to discuss about this module 1. So that is not provided as the schedule for today's class. So schedule for today's class or agenda for today's class is the entire syllabus other than accounting standard segment. So we are now going to focus on the areas, my dear friends. I go with module 3. We start from module 3 and come to module 2. Module 2, few chapters are format oriented. So that is nothing like I could recap on it. That is always a format. Okay. So, but still we will discuss that. We will spend good time on to this bonus, redemption, etc. and all. So we will do that quality time. So, primarily we are focusing on module 3. Say, let us take the insurance claims. From the last 3 examination, I could see the question was testing on to claim for loss of stock. Under insurance claims, there are 2 problem areas. I would say 3 problem areas. It is claim for loss of stock, claim for loss of profit. And we also have a problem area which is not separately discussed in the study model as a theoretical segment, but directly a problem is there, which is computation of insurable amount. So few problems which are there in RTPs, and thereby it came subsequently in the examination also, but of late last few times it did not came. So thereby there is chance it can come. So computation of insurable amount in case of loss of profit. Like that we have 3 problem areas. Loss of stock, insurable amount computation, nothing is there. What stock you have, you're supposed to insure. But profit should be projected and do some calculations, and we should find out the insurable amount. So that way we have 3 problem areas in this particular chapter, insurance claims. Let's focus. So I told you, my dear friends, we have every problem areas that can come in the exam. We can't ignore anything. So, but from an examination perspective, I consider this has got more significance. Why? Because for last 3 examination, we had loss of stock problem. You can check, and thereby high chance that loss of profit can come for the coming examination. Okay, that's all. Proceeding further, that doesn't mean we are going to discuss only that. Claim for loss of stock. So what is that? How to compute? See, when you have taken an insurance policy, and if there is accident in our place, we lose stock, that will be compensated. This is the whole concept. Now, first thing is that who determines the amount of claim? Now, it is not the insurance company. It is the shopkeeper. It is a businessman who determines the claim, which can be verified, investigated by the insurance company. So I should determine the claim. So first I should prove how much stock I had just before fire. For that, we prepare an account which is normally called as memorandum trading account. So we prepare memorandum trading account, in which you will have estimated information about various items in the trading account: opening stock, purchases, sales. Now these are the information for the year in which fire occurred, from the beginning of the year till the date of fire. So from the beginning of the year, what is the opening stock? Beginning till date of fire, purchases. Beginning till date of fire, sales. Then sales related gross profit. So indirectly what we are doing is cost of goods sold. Sales minus GP is cost of goods sold. So what are we doing? Simple common sense approach. Opening stock plus purchases is the total goods available in the shop. This much goods, that is sales minus GP, sold. Balance should have been the closing stock that existed at the time of fire. So by preparing this memorandum trading account for the current year in which fire occurred, we get closing stock as balancing figure. So, and all these information will be given in the question. GP amount alone will be determined by sales into gross profit ratio. Sales into, we are not teaching something, we are doing recap, but still little bit of teaching is also involved here. So that this is the maximum, this is the lowest speed at which I can proceed. So maybe only from here speed will increase only, we can't reduce the speed. Okay, coming back to this, suppose gross profit should be determined as sales into gross profit ratio, and that ratio will be given in the question, and in some problem that ratio may not be given. If it is not given, they would have given information relating to trading account of previous year trading account. So you have to prepare that previous year trading account, opening stock, purchases, sales, and they will also give closing stock. You will arrive gross profit as balancing figure. You will express gross profit in terms of a ratio, which is gross profit by sales into 100. So that is how you should find out the gross profit of previous year, gross profit ratio of previous year. Apply the ratio on current year sales, you will get current year gross profit. You will get closing stock of this year as balancing figure. This represents the stock that we had on the date of fire. From this stock that we had on the date of fire, you should find out what is our loss. Whatever we had fully lost, not necessary. At the time of fire, you would have saved some stock. We call that as salvage value. So thereby it is stock on the date of fire minus salvage value, which is should be given in the question. If it is not given, no salvage value. This is what we called as loss. Then we will go for claim. What is claim, sir? Whatever we expect from insurance company. What I lost, they should compensate me? No. Generally, yes. Sometimes there is a concept of application of average clause. So what is that average clause and all? So you should compare two numbers. Policy amount, the sum insured amount, policy amount should be compared with not loss amount, but you should compare with stock on the date of fire. Stock on date of fire. If the policy amount is equal to the stock you had on date of fire or more than stock on date of fire, no problem. Entire loss will be compensated. Entire loss will be compensated. So if it is, the policy amount is greater than or equal to stock, na, claim is equal to loss. Claim is equal to loss. If policy amount is less than stock on date of fire, which means you have underinsured. You have underinsured. This much stock. 5 lakhs stock you have, but you insured only 4 lakhs. Then they will apply something called average clause. In that case, claim is equal to loss of stock into policy amount divided by stock on date of fire. For example, you lost how much stock means you had how much stock? 5 lakhs. You took policy for 4 lakhs. But even though maybe you saved 1,50,000 and thereby your loss is only 3,50,000. How 3,50,000? I had 5 lakhs, salvage value 1,50,000. I saved 1,50,000. So thereby my loss is only 3,50,000. My loss is only 3,50,000. But we find that the policy was taken for 4 lakhs. Oh, more than loss. Like that you can't tell, because the policy that you are taken as 4 lakhs is much less than the stock on date of fire. So thereby they will not give you 3,50,000 as claim. So they will apply a proportion there, which is policy amount of 4 lakhs divided by stock on the date of fire. So like that, when you apply, my dear friends, you get an amount of 2,80,000. This relating to claim for loss of stock. Hope you understand this. When you prepare this trading account of previous year or memorandum trading account of current year, so those items which you find should not be there in the trading account should be eliminated. Examples: purchases include purchase of machinery. Suppose you have direct expenses like wages includes installation expenses. Similarly, goods consumed by the proprietor. All these things, my dear friends, should be eliminated from trading account, either from deducting from purchases or you can credit in the trading account credit side. Similarly, sales should have the related proper sales only. Suppose like you have sale or return basis transaction, then accordingly whether it is sold or not you should check, and accordingly you should consider. About trading account should consist of the trading activities of the current business only. So like that you should understand few adjustments. If you practice problem, you will be getting it. The broad concept of claim for loss of stock, claim for loss of profit, which is the significant area from the coming examination perspective. So it is claim for loss of profit, claim for loss of profit. So here what is getting compensated? What is the whole concept? Because of fire, my business is interrupted for some period. So it is not merely because of loss of stock and all. My place is interrupted, place is damaged, so my business is affected for certain period. So if the fire did not come, I would have made some quantum of sales. Sales only gives me profit. If I don't do sales, I lose sales and thereby I lose profit. That profit is what compensated. So I actually lose sales. Because of sales loss, I am losing profit, and the insurance company commits me to give me compensation for profit. So primarily, what is the compensation? Profit relating to sales lost during the fire affected period. What is the compensation? Profit lost due to sales lost during fire affected period. This fire affected period is normally called as the compensation period. But sometimes they will give two period. One is called indemnity period, which is the period mentioned in the policy. Say it is 4 months. Fire affected period, say 5 months now, they will give you compensation only for 4 months. So many questions give you only one of these two period, then it is that period is compensation period. But remember, if two period given, then out of these two period, whichever is lower is what you should consider as the compensation period. This is first point. So first decide how many months you want the compensation. That is called compensation period. Next, you should prove how much sales you have lost. How much sales you have lost. For example, if you are affected for suppose August, September, October of 2023 because of fire. First August fire accident and 3 months you were affected. In that case, what we normally do, I need to prove how much sales I have lost because of fire during this 3 months. First I should prove how much sales I would have had. How do I prove that? I should compare naturally with the preceding period. If no previous exists, some other assumptions, some other estimate will be made. So generally, comparison with previous year. Thereby, my dear friends, we will take the same compensation period, August, September, October of 2022. This is the sales I made. But last year, whatever I made, this year also, I expect same amount of sales. But sometimes there will be some increase or decrease I expect. We call that as trend. So it is not necessary that whatever sales I made in the last year should also be sales in the current year. Thereby, last year 22, 3 months this much sales. But regularly, I am making an increase of 10%. So I make everyday improvements in my life, improvement in my business. So you expect this much sales. Sorry, this is what you lost up. Not necessary, because though in 2023 you are affected, doesn't mean you made zero sales. Maybe here and there you made little amount of sales. So that actual sales I should deduct. The balance is what I have lost. So thereby, sales during the compensation period of previous year plus or minus trend is what I expected in the current year if fire did not come. But because of fire, I could do only this much. Balance is what I have lost. This is a sales lost. This will be compensated? No. So they will compensate you profit relating to the sales. On this sales, I should multiply by something called gross profit ratio. So first you should calculate gross profit ratio. Gross profit ratio. How to compute that? It is GP by sales into 100. Correct. GP by sales into 100. GP is nothing but balancing figure in the trading account. Wrong. That is wrong. In loss of stock, GP means balancing figure in the trading account. But here we got a different concept. Say you have trading account, you have P&L account. So what happens means you have sales, cost of goods sold, which comprise of opening stock, purchases, closing stock. You will get gross profit. Gross profit you have. Generally, P&L will have fixed expenses. We call the standing charges. In that standing charges, standing and fixed expenses mostly. Many of the expenditure would have been mentioned in the policy. We call that as insured standing charges. Sometimes you missed out few standing charges to be mentioned in the policy, not covered by the policy. We call this uninsured standing charges. We may have some variable expenses. You will have net profit, my dear friends. So this claim for loss of profit, they will not be compensating you. See, actually this GP minus all these three amount is net profit. We will compensate you net profit. We will compensate you insured standing charges. Variable cost, anyway you are not losing because you are not incurring. Because variable cost, now only when you have operations you incur it. So you are not losing it. Uninsured standing charges, you are incurring, you are losing. But you didn't mention in the policy, no. So you lose it, you suffer. So thereby, what is gross profit as per this policy means? It is nothing but net profit and insured standing charges. So this will be expressed as a percentage of sales. But GPR you take for loss of stock and GPR you take for loss of profit. Both are different. GPR is equal to GP by sales into 100 GPR. So GP is nothing but net profit plus insured standing charges. Question will definitely give you the breakup information of insured and uninsured standing charges. Sometimes question will tell total standing charge, this much is insured, or sometimes they will tell this is insured, this charge. Addition, we call that as gross profit for this policy alone. Under the previous one, loss of stock balancing figure in trading account is how we are understanding. So thereby GPR, how to compute? First GP, net profit plus all these things, only demonstration. You should do only this much step, picking information from the question, net profit plus insured standing charges, and GPR is equal to GP by sales into 100. And for GPR also, question might give you some trend. For example, say this is coming to 18%, and question says that the rate of GPR increases by 2%. Rate of GPR increases by 2%. Now, you should not take 2% of 18%, because rate increase na direct addition 18% plus 2%. Directly we should be taking this as 20%. Like that we should understand, my dear friends. Okay, but GPR is equal to 18% plus 2%. It is 20%. Hope you are following this. This is how we'll be computing GPR. Then step number 4, my dear friends. So first step is to identify the compensation period. What is second step? To identify the short sales. How much sales we are losing? We call that as short sales. Step number 3, what? Computing this GPR. Step number 4, GP on short sale. Short sale means how much sales we have lost. So it is nothing but short sales into GPR will give you GP on short sales. Basic claim is over. Now, my dear friends, this is the primarily they are giving you claim. Actually, this claim consists of 2 components. What are the 2 components? Means they are compensating you net profit. They are also compensating you insured standing charges, which means those expenditure which was mentioned in the policy. Now, after fire, you are incurring some new expenditure, but that new expenditure is not mentioned in the policy. Will they compensate you that amount? Na? Sometimes, yes, they will compensate you that amount also. What is that amount means? That is called increased working expenditure. Why are they compensating? I will tell you. That expenditure will be compensated only if that expenditure is incurred to increase sales during the fire affected period. So August, September, October, you are affected by fire. Now, during this period, if you hire the nearby place by paying a rent, you can increase the sales. If you increase the sales, the insurance company's compensation amount reduces. So thereby, they will encourage you to incur that expenditure, which they agree to compensate. So we will be having something called the claim for increased working expenditure. Increased working expenditure, also called as some question like increased cost of working. What is this amount? This is an expenditure incurred exclusively after fire to increase sales during the fire affected period. So they encourage me to incur this expenditure because insurance company is having some gain here, because their claim is getting reduced in computing the GP on short sales. Because if I increase sales, the reduction in sales is getting avoided. Short sale is getting avoided. So they will give me compensation. To compute this compensation, we should compute something called GP on adjusted annual turnover. There is something called adjusted annual turnover. Turnover means sales. So annual means 12 months sales. Adjusted means you should make some adjustment. What is it? First, annual turnover. Annual turnover means, for example, fire occurred on 1st August 2023 means sales during 12 months immediately preceding the date of fire, which means it is from 1/8/22 till 31st July 23. 31st July 23. So this is what we are understanding as annual turnover, 12 month sales. So 1/8/22 till 31st July 23, that sales is what we are understanding as annual turnover. Again, Question would have given something called trend. What trend? Sales trend, gross profit trend. Gross profit trend should be applied on the gross profit ratio. Sales trend is different. So don't get confused. So if the question gives sales trend, apply the sales trend only on sales figures. That ratio should not be applied on the GPR and all. Okay. Sorry. This annual turnover should be given in the question. If the trend is given, the trend should be applied. Plus or minus trend will give you adjusted annual turnover multiplied by the gross profit ratio as we originally computed for GP on short sales. Same GPR will be taken. You'll be getting the GP amount, which is equal to AAT into GPR. AAT into GPR will be getting the GP on AAT. For what purpose this GP and AAT required? That you tell, sir. I will tell you. I told you we have something called, in addition to claim for sales lost, claim for GP on sales loss, that is a claim. Plus, we also have claim for increased working expenditure, claim for increased working expenditure. Sometimes it can come for 10 marks. So don't lose this. Simple 8-step approach I will tell for computing the claim for loss of profit. So step number 1, identifying the compensation period, August, September, October, like that, pakkava. Then step 2, finding how much sales you have lost. How to find out sales loss? The same 3 months in the last year or same 4 months in the last year. Then suppose any sales trend given on a check. If it is given, that trend will be applied. You will be getting expected sales. From the deduct actual sales done during the fire affected period, you will get sales lost. Then find out GPR. For the net profit of last year, insured standing charge of last year will be aggregated. You will get GP. Express that as a percentage of sales of last accounting year, not like immediate 12 months, last accounting year, maybe 22, 23, like that, April to March, like that. That sales will be applied. You'll be getting GPR. Then on the sales lost, multiply by GPR, you will get GP on sales loss. We call this sales loss as short sales. Then step number 5, we should calculate something called GP and AAT. What is that? First, take that immediate 12-month sales, apply trend, you will get AAT, adjusted annual turnover, multiply by the same GPR, you will be getting something called GP and AAT. Very simple, 5 steps. 6th, the claim computation for the additional expenditure. So, which comprises of 3 computation. One is, you will take actual expenditure. Whatever actual expenditure incurred. Sir, after fire, extra, additional, I paid 30,000 expenditure. Okay, that is what actual expenditure. Say 30,000. Next, we have that actual expenditure into GP on AAT. In regular class, we should tell logic behind all this application and all. Now, this is not the right time. So, GP on AAT divided by GP on AAT plus UASC. What is this? So, we calculated something called GP on AAT previously. AAT multiplied by GPR. The same number in the denominator. But you should always understand the GP always comprise of net profit and insured standing charges. Here in the denominator, you will also include uninsured standing charges. So, in this proportion only, they will give you compensation. GP on AAT divided by GP on AAT plus uninsured standing charges, which should be also mentioned in the question. Next, it's very simple. Another unique number, which is gross profit on something called RETA, reduction in turnover avoided. What is this? Very simple understanding. People get confused by reading from the textbooks and modules also doesn't explain properly. Very simple. You incur this extra expenditure for what purpose? Tell me the purpose. To increase sales during the fire affected period. How much extra sales you could increase because of this extra expenditure? That is what RETA. That is what reduction in turnover avoided. Which means, my dear friends, question is telling you like this. We incurred 30,000 expenditure. We incurred 30,000 expenditure during the fire affected period. During the fire affected period sales. FAP, fire affected period sales. Suppose it is given as 5 lakhs. and we incur how much expenditure? 30,000. Question says that it is for 70% of sales. So which means this is the sales made during the fire affected period. You incur 30,000. If this 30,000 not incurred, sales will not be 5 lakhs. The question directly telling you incurred 30,000 and within bracket they are telling it is for 70% of sales, which means 70% of this 5 lakhs was possible only because of this extra expenditure. So in this example, my dear friends, Rita is nothing but 5 lakhs into 70%, 3,50,000. So you should follow. Again, we may, I think it is recorded and all. So you can just listen 1 or 2 times. So it is very simple. So when it is given 30,000 for 70% of sales, then 70% of 5 lakhs is possible only because of this expenditure, which means if this expenditure not incurred, sales would have been only 1,50,000. Because of this expenditure, sales become 5 lakhs. Extra sales is nothing but 3,50,000. This is Rita, but you don't consider GP on, you don't consider Rita amount fully. You should consider GP on Rita. So on this, multiply the GPR, which is say 30% or 40%, whatever rate originally you found out. You're using the same ratio third time now. So multiply, and that will be GP on Rita. Out of these 3 numbers, lower of these items will be considered as claim for IWE. So what is the claim for IWE? It is actual expenditure, actual additional expenditure, or actual expenditure into a proportion. What is the proportion? GP on AAT divided by GP on AAT plus uninsured standing charges. Third, it is GP on Rita. Like that, we have 3 numbers computed. Out of these 3, whichever is lower should be taken, my dear friends. Then finally, we will have something called the claim. Gross claim, I would say, which is nothing but GP on the short sales. You lost this much sales, related GP. Claim for that IDWE. Now these 2, when it is added, you should know they are giving compensation for net profit. They are giving compensation for insured standing charges. They are also giving compensation for some expenditure incurred after fire to promote sales. But from this expenditures, when you have some savings in expenditure, so which means you are getting money from insurance company for expenditure, but you are not incurring that expenditure, then that should not be asked from insurance company. So you should deduct that amount called as savings in insured standing charge, which is a number that should be given in the question. So these 2 are added and this number is deducted. We get the gross claim. So why do we call this as gross claim? We'll be having something about net claim. Again, you should compare policy amount and another number called GP on AAT. So if policy amount is greater than or equal to GP on AAT, net claim is equal to gross claim. But if policy amount is less than GP on AAT, which means we expect you to take this much insurance, you have not taken, then net claim is equal to, like how we applied average class for loss of stock, it is gross claim into policy amount divided by the GP on AAT. There we say stock on date of fire. Here it is GP on adjusted annual turnover. So this is how 8 simple steps, my dear friends. So operator we used to do for 3-4 hours to explain these 8 steps in a regular session. This much only we can do, my dear friends. So this is how we compute claim for loss of profit. Because recap session is a too elaborate form of recap. Now the third problem area is computing insurable amount. So how to compute insurable amount means, listen carefully, my dear friends. See, you will have a preceding period sales will be given. Based on this, you should project the sales of future. Project sales. First you should calculate projected sales. When you're going to take insurance, you should take projected sales. அப்போ அதுக்கு preceding period sales or current period sales plus or minus train, all this information expected to be given, you'll be getting projected sales. Similarly, you should find out GPR, which is GP by sales into 100, and where GP is equal to net profit plus standing charges. Sir, is it not insured standing charges? No, because now only you're going to suggest about insurance, sir. So you tell all the standing charges should be insured. So the previous case already insured, policy taken, they are now coming to you for calculation of claim. Now you're suggesting how much insurance should be taken now, net profit and all standing charges. So to be included in GP and explain and work out the GPR. Now insurable amount will be nothing but projected sales into GPR will give you projected gross profit, which is the normal insurable amount. But to this, an addition to be made is that increase in standing charges in future, which would not have been taken in the GPR. GPR amount would not have been taken because GPR is based on last year. Now, increase in fixed expenses. So, salary is going to be increased by 2 lakhs. Interest going to be increased by 3 lakhs. Rent increased by 4 lakhs. That increase in standing charges. This is how we plan for insurable amount. Projected sales, projected GPR, projected sales into projected GPR will give projected GP. Plus, is there any increase in the fixed cost will be considered as insurable amount, my dear friends, is the third problem area. You have one question in the study module. Based on this, you can solve that particular problem and you can practice it. Okay, so with this, we are concluding on to say one chapter of that, all the chapters that we have listed out, which is insurance claims completed. Now we're going to take the next chapter for recap, which is investment accounts. Investment accounts. Normally, we discuss this in two segments. One is from an accounting standard 13 perspective. Then the chapter investment account, AS13 again, you will be discussing as an accounting standard segment, which is not scheduled for today's class. Directly, my dear friends, we have two problem areas. Accounting for investments, when we say accounting for investment, mean accounting for transaction involving investment. There are only 3 transactions. 3 transaction journal ledger, if you know, this chapter is over. Many students know will have a lot of fear for this chapter, but actually one of the easy chapter. If you have some interest in basic calculation, not, I would not say mathematics, you should be having interest in mathematics and all, then people will run away. Simple multiplication, computation, interest, etc. If you know, then it is easiest chapter, my dear friends. Okay, so you have 2 types of investment. One is called fixed income bearing securities, and you have variable income bearing securities. So you have debentures, bonds, government securities. All these things comes here under fixed income bearing securities. Shares, generally equity share, preference shares also will come under this category. Even though rate of dividend is fixed, but dividend is not mandatory, dividend is not certain. So thereby it will come under variable, but your problem areas in a study model covers only equity shares. Okay, so like that you have fixed income bearing securities, variable income bearing securities. Sorry, before we explain this accounts, basic concept what abdina, I told you the transactions are 3 in numbers. Purchase of investment, sale of investment, purchase, sale, receipt of income from investment. Even though it is not part of AS13, but investment account chapter covers that also. Receipt of income. Like that, 3A, 3 transaction, then one event which is valuation at the year end. Valuation at the year end. This is an event. So 3 transactions are purchase of investment, sale of investment, receiving interest or dividend income. So when you make investment for getting this income only, then at the year end you value. This is the maximum accounting that you should be learning. Is the first point. Second point is that, my dear friends, in a company, I invested in debentures, and I was having the debenture for 7 months. I was having for 7 months. Later on I sold. So Mr. J was holding for 7 months and sold to Mr. K, who was holding in that year for 5 months. in the year 22-23. So investment in debentures of X Limited, I am holding for 7 months, another person holding for 5 months. Now this X Limited only pay interest. They will not pay interest like this. 7 months to me, 5 months to him. Though we deserve like that. I deserve 7 months interest because I invested in the company for 7 months. After 7 months only I sold. So I deserve 7 months. He deserves only 5 months. But the company X Limited will pay 12 months interest to Mr. K. They won't pay 5 months. They will pay 12 months interest. They will pay. Finally, what is the concept? They pay interest to the person who is having the debenture at the time of payment of interest, at the time of payment of interest. So, what are you finally telling? The point is, since the company paid 12 months interest to Mr. K, I feel so sad that I deserve 7 months. So, what I should have done is that I lose control after my selling to Mr. K. At the time of my sale, I would have collected from Mr. K money for debenture and money for 7 months interest. Because he will get 12 months interest from the company, thus he is also not losing anything. He pays me 7 months interest and he receives 12 months interest from the company and he earns in net 5 months interest. So I am also not losing, he also not losing, all of us are happy. So if the company only directly gave the 7 months and 5 months, no problem, everybody would have happy in accounting also. Now J happy, K happy, company happy, but students not happy because we have some complex accounting here. What is that? So the point is that whenever we buy investments or sell investments, what is involved is not only the value attributable to that investment, some accrued income also attributable. So when you buy investment, from Mr. K's perspective, he pays money for investment. He also pays money for interest to bank. This is the journal entry. So always entry is investment debit, interest debit to bank. Investment debit, interest debit to bank is the entry, my dear friends. Okay. And the standard AS 13 says that the interest is actually for 7 months. It is held by Mr. J, which means this is actually called pre-acquisition income. What is this pre-acquisition? Because this interest is relating to the period prior to my acquisition. So this should not be forming part of cost of investment. I am paying money for investment. I am also paying money for interest. This will be later on I recover. So this is not part of cost of investment. So always entry is investment debit, interest debit to bank. Now there is a concept of X interest, cum interest. X means excluding interest, cum means including interest. What does that mean? Suppose question says that purchased for 1 lakh X interest means what? You should not pay interest. You need to pay only investment amount. You should not pay interest. No. X cum means the given value in the question does not include interest. Cum interest the given amount in the question. Suppose it is 1 lakh given and the 1 lakh already includes even money for interest. That's all. Exo commo, whether it is X or whether it is cum, you have to pay money for investment. You have to pay money for interest. But what is the whole concept, sir? If it is X interest 1 lakh doesn't include interest. It is a money exclusively towards investment. You should calculate interest separately. That interest calculation, 2 simple rules. What are 2 simple rules? One, interest should be calculated on face value. Suppose I am purchasing debentures of face value 90,000 for 1 lakh. Face value 90,000. Interest should be calculated on 90,000. See if it is for 10%, then it is for a period of 7 months. So into 7 by 12. So what is this 7 months, my dear friends? The period should be always from the last time that X Limited paid interest, that date to the date of transaction. It is not that how many months J was holding, how many months K was holding concept. It is the last interest date to the date of transaction. Suppose I am buying this on 1st August. 1st August. The last time the company paid interest on 31st March. Then April, May, June, July. 4 months interest only I should calculate. So suppose they have paid interest till last 30th June. Then it is only July month interest, 1 month interest. I should always calculate interest. It's an independent principle. 2 rules. 2 rules you correctly apply. Calculate interest. Then this chapter is an easy chapter. So what is it we should do? Calculate interest. The same is applicable for redemption of debenture chapter also. Same is applicable for redemption of debenture chapter also, my dear friends. It is investment debit, interest debit to bank. So how to calculate interest? Interest should be calculated on face value. Interest should be calculated for what period? Last interest date to the date of transaction. So like that you calculate the interest amount. Then together is what you will write against bank. So is what the basic first thing. If the question says purchased for 1 lakh come interest and the 1 lakh already includes interest. So that is the amount you should write against. That is the amount you should write against bank. So interest will be again independently calculated. Whether the question says X or commo, interest calculation will remain the same. Always compute on face value. Always compute for what period? Last interest date to the date of transaction. You will get investment amount balancing figure. X na bank amount balancing figure. Come interest na 1 lakh is the bank. Interest independently calculated and investment value will be the balancing figure. This is the basic concept of purchase entry, X interest, come interest. Same way, you'll also make the sale entry, my dear friends. Before that, when you receive interest, that is going to be very simple, bank to interest. Earlier it was X, earlier it was come, doesn't matter. When you receive interest, bank to interest. How many months? The company is paying 6 months interest now, I will get 6 months interest. The company paying 1 year interest now, I will get 1 year interest. I should not look into, I am holding for 2 months, I am holding for 3 months, doesn't matter. Company will pay full interest to me, the person who is holding the debenture at the time of payment of interest. So bank to interest, the total interest paid by the company. So again, it is on calculate on total face value, not recently purchased face value. Suppose opening I had this much, then I purchase something now, total face value into rate into the number of months by 12. Either it is 12 by 12 or 6 by 12, depending upon how many months the company is paying interest. Sale, my dear friends, exactly ulta entry. What is that? Bank account debit to investment, to interest. Again, interest will be calculated separately. Investment will be recorded book value based on what you debited at the time of purchase, computed by applying either FIFO or weighted average. Hope all of you know how to calculate the FIFO or weighted average concept. So you have like lot 1, 500 debenture purchase. Then you purchase 700 debenture. Now you sold, suppose 540 debenture. Now FIFO means 500 first. Suppose this was 50,000 and this is like 700 debenture. It is like 84,000. In that case, this is fully sold, and out of this 40 should be separately calculated. 540, like that you should find out FIFO. Weighted average now, this is 1,200, this is 1,34,000. Total cost by total numbers into number of debentures sold. Like that you should calculate weighted average book value. So that is how we'll arrive at the book value. This is interest. Bank will be to the extent of the sale value plus interest. Sale value plus interest, and you will have difference, which is nothing but profit or loss. You will have difference, which is nothing but profit or loss. What we explained in journal is what will be posted in the ledger account. So practice that ledger account, my dear friends. Okay. So ledger will have a format like this: investment in debenture. What is the format? Now I will tell you, my dear friends. It is date, particulars, face value column. This is not for a ledger journal concept. It is only mentioned in the quantity column, a dummy column representing the quantity column. Interest amount or actually two ledger account. Amount column represent investment, interest column represent interest account. Two different accounts combines into form a single account. So date, particulars, the quantity is face value, interest amount. Suppose you have on 1st April, opening balance, face value, say 50,000, but other cost is 60,000. So then by 1st August, you purchased face value 70,000. At that time, interest definitely will come. Definitely interest will come. X interest also interest will come. Come interest also interest will come. Separately go and calculate on face value for the period from the last interest date to the date of transaction. Then question says purchased for 3 lakhs, come interest. Then 3 lakhs minus interest is what you write in the amount column. Question says purchase for 3 lakhs X interest, then directly write 3 lakhs in the amount column. This is how you should directly post this. And sale wise, it is by bank, post that quantity column, interest independently calculated, sale value posted, not book value, sale value posted. Separately calculate profit or loss on sale by comparing sale value and book value. We will have profit or loss, and if it is loss, then it is by P&L. Amount will be recorded in the amount column. If it is profit, it is to P&L. So I have explained journal, I have explained ledger posting for purchase and sale, and finally you go for the balance. Balance is representing the cost. Question separately give you the fair value or market price by year end. You should compare these two value and take whichever is lower for the valuation purpose. This is accounting for fixed income bearing securities. Accounting for fixed income bearing securities. Recap has been completed, my dear friends. Some 8 hours, 9 hours discussion we have compressed into some 15 minutes. Next, we have variable income bearing securities. When you buy equity shares, buying very simple, easy, because there is no concept of X come dividend here. It is when you buy shares, definitely we cannot calculate what is the dividend accrued till date, because who knows how much dividend company will pay. Year 1 they pay 20%, another year 40%, another year 60%, another year 10%. Who knows? So when you buy equity share, entry is investment in equity shares to bank. That's all purchase entry. So this is simple purchase entry. And if you have any brokerage and all, that also should be added to the cost of the investment. When you have sale, bank account debit, it is a sale value, net sale value. If you have brokerage, should deduct that. Credit investment, which is nothing but again book value determined by applying FIFO or weighted average. Difference on the profit or loss on sale. Simple purchase and sale entry. So here, why interest dividend is not coming? Because at the time of purchase and sale, we definitely will not be knowing how much is the interest or dividend. The coming examination, last 2 exams, we find questions from debt, bonds, etc. So high chance that there could be an equity question this time, my dear friends, or it could be a question from debt also, because last examination question on, it's a combination of debt and equity, both we had in the examination. Anyway, so here we can't tell, like, this is what more significance and all. Both we are studying with equal prominence. Upon when you buy equity shares, no concept of X come and all. Investment to bank, bank to investment, difference is profit or loss. Now the point is, when you receive the dividend, receive dividend, here you have complication. If it is fixed income bearing securities, at the time of purchase, at the time of sale, you properly identify what is the interest. So that when you receive the interest, it is bank to interest and you don't have to make any further calculations. But in case of shares, when you buy the shares, sell the shares, no complication whatsoever. Investment to bank, bank to investment, easy. But when you receive dividend, you should classify the dividend into pre-acquisition dividend, post-acquisition dividend. This pre-acquisition dividend will be treated as recovery of cost, which means what are we treating? I am assuming this pre-acquisition dividend was included in the cost. So now that I am receiving it now, it is not my income. It is only recovery of cost. So I should be deducting from investment. Entry will be bank to investment. It is credited to investment account. If it is post-acquisition dividend means, which means it is a dividend related to the period after my acquisition. It is my own income. I credit to P&L. That is bank to dividend, and which will be transferred to P&L account. Like that, I should classify the dividend into pre and post. So many students usually struggle in this area. I will tell you, my dear friends, you should have two data to know whether it's pre or post. One is the dividend when I receive, the dividend period should be very clearly mentioned. This is the dividend of the year 2022-23. Like the question says, then it is for 1/4/22 till 31st March 23. This dividend. Now, take one more data. You purchased the share and thereby you're getting dividend now. When did you purchase the share? Sir, I purchased the share on 1/4/23, sir. How come, Pa, you purchased the share on 1/4/23 and you're getting this dividend? Because the company, when they are paying dividend on 1st July 23, dividend of 1 year, no, they will pay only after like 3 months, 4 months when they conduct AGM and declare dividend, pay dividend. Upon 1st July, they are actually paying this 12 months dividend. When they are paying dividend on 1st July, doesn't mean the dividend is still 1st July. Interest madri illa. 1st July, they pay dividend means, I should tell which year dividend it is. And they are very clearly telling it is dividend of 22-23. So I purchased the share on 1/4, so I am getting this dividend. But I know that this entire period is prior to my acquisition. Then in that case, entire dividend is called pre-acquisition dividend, and it should be reduced from investment. It is called recovery of cost. This concept you should be knowing. A question should very clearly tell two data, my dear friends. What are the two data question should tell? The question should tell the data like this. The dividend relates to which period? The dividend relates to which period? Number one. Number two, the question should also tell when did you acquire the share? Suppose the question lacks information. Sir, this dividend is related to which period? Question is not telling. In that case, always dividend will be taken as post. Now you have seen solving many problems. Sir, so those who are confused, I am not knowing why pre, post and all. Whenever you could not classify into pre and post with crystal data, always it is post. Always it is post. So whenever you see interim dividend, they don't give period and all. It is always post. Whenever they give dividend only, they don't tell interim or final. They are not giving any period. Always post. Dividend is always income. Is what you should understand. Pre na in the rend data required. Which two data? Dividend relates to which year? When did I purchase? Suppose I purchased on 1st August 2022 na. Then prior to this period is pre, and after this it is post. Like that we should understand about pre and post acquisition dividend concept. Similarly, we also have bonus and right shares. Bonus shares means first I purchased 500 shares for 60,000 rupees. Then I am getting 1:1 bonus. So I am getting free 500 shares. No journal entry for this. But if you are preparing ledger accounts, that number will be added in the quantity column, and nothing will be in the amount column. Journal entry, no, but posting in ledger account only in quantity column, stating that now 1000 shares order cost is 60,000. Originally, I purchased 500 shares in the market for payment of 60,000. Company gave me free shares, that is called bonus shares. So now 1000 shares cost me 60,000 is the concept. So no journal entry for bonus, but posting in the ledger account only in the quantity column. Rights issue. Rights issue. Generally, we buy shares nale is always from there. So it is given Mr. X purchased shares of J Limited. Like that given na, it is always purchased from the market, not from J Limited. Mr. X purchased shares of J Limited, maybe from Y, maybe from K. In the market, he bought. It is not from J Limited. Now, J Limited, when they issue shares, it is called as rights issue, bonus issue, like that two issue only, my dear friends. Okay. Apo rights issue na, J Limited says that, so you are holding 1000 shares. Now you can buy another 600 shares by payment of 75,000. Buy another 600 shares by payment of 75,000. Offer is to you. If you don't buy, we will give it to third party. So I am having a right to buy some shares for say 150 rupees each. 90,000 I can buy 150 rupees each. I can buy for 150 rupees. So I have to pay 90,000. Now this right shares, there are two possibilities. I exercise the right, which means I pay 90,000, I buy 600 shares. Doesn't matter whether I buy shares from the market or buy shares from the company, entry remains the same. So if I exercise the right, no complication, investment to bank. I buy shares in the market, investment to bank. I exercise right shares, investment to bank, no complication. But the problem is that, my dear friends, suppose I don't have 90,000, but so I can't buy the share. But my friend want to buy these shares, and company allow me to transfer this right to my friend. So what I am telling is that my friend, give me 10 rupees per share per right, and you can buy the share. So I am transferring my right. I am not selling shares. I am selling my right to buy shares. So from that, I am getting some income. 600 into 10 rupees is income. This income generally goes to P&L. Generally, income goes to P&L. But the standard says that this area highly chance of getting tested in the examination. The standard says, suppose the 600 shares you are getting it. Why? Because you are already holding 1000 shares. No. These 1000 shares, if you have acquired on come right basis, you are getting 600 because already you are holding some shares, which we call henceforth as original shares. Original shares, right shares. Upon the original shares, because of the original shares only, you are getting right shares. So, if this original shares has been acquired on come right basis, what does it mean? Question telling that these shares are acquired on come right, including right. You paid money for right also. Number one. Number two, market price of the share after rights. Market price of the share after rights reduced as compared to the price before the rights. So in that, if these two conditions satisfied, these rights income will not be taken to P&L, will be treated as recovery of cost and thereby credited in the investment account. Once again, if you exercise the right, no problem, investment to bank. But if you transfer the right, you get some income. Such income always credited in P&L. But if two conditions satisfied, these shares were acquired on come right basis. How do I know? Are they X right or come right? Question should tell come right. Question doesn't say come right. It is always X right. Very simple. Abba, happy. Then it is credited to P&L. Simply mention a note, it will be credited in P&L. Don't record anywhere in the investment account. But question says it was acquired on come right, and they are telling market price after rights reduced by 4,000 rupees. Oh, then 6,000 is my income, market price reduction 4,000, then only up to 4,000 it is treated as recovery, and remaining 2,000 will be credited as income in P&L. So to what extent market price reduced? That how do I find out, sir? Adu question should tell. Oh, everything will be given the question. Yes, Pakkawa should be given. If not given, what is my assumption? It is fully income. 6,000 is fully income. Two information, very clear question should tell. What two clear information? That it was come right. Also market price reduced by this much. Like that question tell, then I can treat it as recovery of cost and there will reduce some investment value. Otherwise, always it is my income. That point also you should be knowing, my dear friends. Okay. So this is the accounting for investments. So with that, that chapter is over. Now we are going to take discussing about hire purchase transaction. I'd like to take the discussion about hire purchase transaction, my dear friends. as far as hire purchase transaction is concerned, the basic concept is that the physical delivery happens, consideration of the transaction happening in installments, ownership, last payment. Ownership transfer happen on the last payment. You know what is HP transaction. You have accounting in the books of hire purchaser, two parties, hire vendor, seller, purchaser. Even though by the commencement of this transaction, purchaser is not getting the legal ownership, but he will be recording as if it is his own asset. Because the concept behind is that this hire purchase transaction, though legally they drafted this like some sale transaction and all in installments, but in substance I am taking a loan from the hire vendor and I am buying the asset on outright basis, and what I am paying is nothing but loan with interest. What I am paying is only loan with interest. So which means right on day one only I have bought the asset on outright basis. This is the whole concept. Which means we will be recording the asset. We will be recording the asset at a price called cash price. This is the outright sale price at a price called cash price. Asset will be recognized at cash price. My dear friends, so usually they are selling for some price na, say 100 lakhs. Then because you are paying in installment, I will collect some interest portion. So 20 lakhs. So like that only it is made of 120 lakhs. So asset will be recorded cash price. So that money is payable to hire vendor. Will be making the first entry. Obviously hire vendor books it is hire purchaser debit to hire purchaser debit to, instead of asset is a regular seller of that goods. Then it is sales for him. To differentiate this sales, he will call it as hire purchase sales. Like that we are making the first entry, my dear friends. Next, there will be a initial payment called down payment. Hire vendor to bank. Hire vendor to bank. Initial payment, we call this as a down payment. So suppose this is 100 lakhs and obligations to pay 120 lakhs including interest. Imagine I am paying suppose 12 lakhs. This is down payment. Now I actually pay 12 lakhs, balance I have to pay 108 lakhs, which I pay suppose in 3 installment of 36 and 36. Now by end of first year, now this 100 lakhs only is the cash price minus down payment. So these two figure, adjusted figure is called principal portion. The real loan is only 88 lakhs. On the 88 lakhs, I charge interest or I have to pay interest, and that is how it is becoming 108. Even though I added 20 here on 100, but this 20 lakhs is not a charge on 100 lakhs, it is actually a charge on 88 lakhs. What is 88 lakhs? Principal portion. What is principal portion? Cash price minus down payment. Cash price minus down payment. So that way, my dear friends, it is by end of first year, you make these payments. Entry will be, first you should make the due entry for interest. Interest to hire vendor, which is 88 lakhs into interest rate should be applied. 88 lakhs into interest rate should be applied. Then hire vendor to bank, which is nothing but the 36 lakhs, the installment agreed. Then that interest will be transferred to P&L. Like this, every year, same entries will be following, amount will change. Same entries will be there, amount will change. So primarily we have only 4 or 5 entries. First entry, asset to hire vendor at cash price. Immediate payment, hire vendor to bank. Every year end entries, interest to hire vendor to bank for installment amount, and P&L to interest. Interest calculated on what amount? The reducing principal. So you had 88 lakhs principal, on that you calculated interest. So that on that only you calculate interest for the first year. Second year what amount? Na 88 lakhs plus interest minus installment. You will have reduced principal. On that you calculate. Like that it goes on, my dear friends. This is basic accounting. Apdiye ulta accounting you find in the books of higher vendor. Many times they are not going to ask you this journal ledger. So because it's mechanical entries every year, the focus will be on the computation of few things. So in higher purchase, 5 marks or 10 mark question only maximum possible. The computations are computation of higher purchase price, computation of cash price, computation of interest when rate given, computation of interest when rate not given. Rate not given. Also finding installment value. Also finding installment value. These are the various computational problem areas that regularly comes in the examination. Adala most significant, they will ask you computation of cash price concept. How to compute this cash price concept now, my dear friends? For example, question is giving you like this. Question is giving you installment value 1, installment value 2, installment value 3. Also, they give you the down payment. All these installment payment plus down payment can get you HP price. This is the total amount paid in installment. This is the payment made initial. So total of all the payment is nothing but HP price. But from that, the interest portion deduct manna, you'll be getting cash price. But how to calculate this? Na? You go have a different, you have a reverse approach concept. This reverse computation concept, my dear friends, had come in the examination for last 3 examinations. So thereby, from this coming examination perspective, I expect more of this interest calculation either by rate given or rate not given. Suppose interest rate given, na, simple format for computation. Year, payments, principal outstanding. By year 0, say interest installment. Suppose 50,000 is the cash price and 14,000 is the down payment. Then principal outstanding is 36,000. And imagine interest rate is given as 16%. So in that case, by end of first year, you calculate interest. 16% on 36,000, my dear friends. Say it is, we don't have calculator, 5,400. And 5,760. 5,760. And my dear friends, installment also they should be giving. Installment amount also should be giving. Imagine it is given as the first installment as 17,760. Then I'm just explaining you how, if these numbers given, rate given, installment amounts given, how to find out the interest for each of the year. So here it is nothing but 36,000 plus interest minus installment will give you second year, the principal portion. So 24,000 into 16%. So we will be getting, my dear friends, it is 3,920. 3,820. 3,820. Imagine they have given this 3,240. 840. 3,840. So 15,840, my dear friends. Imagine given as principal. So you have 12,000. By year 3, you will apply 16%. You will get 1,920. So you have like 13,009. These are principal given. So I'm just explaining you how to calculate this reduced principal on which you're supposed to calculate interest. So question has given what number? Question has given cash price 50,000. Question has given down payment 14,000. Installment 1, 2, 3 values given 17,760, 15,840, 3920. How to calculate interest? On the first year, calculate on 36,000, which is 5,760. Second year, how do you got this 24? 36 plus interest minus installment, you get 24. Like that simple interest calculation. Now, the examination, what I anticipate more is that where a question without interest rate, no interest rate given, then my dear friends, you should know how to calculate this interest rate, which is nothing but IRR. What is this IRR? Means it is a rate at which installments, if discounted, equals cash price minus cash down. That is principal portion. Apo question is giving you 17,760. Question is giving you 15,840. Question is giving you 13,900. These are the installment amount. If you discount by using random rate, you should be getting 36,000, which is principal portion. That number is given. Apo, how do I find out that IRR by applying random rate and all? See, in a practical scenario, you may have difficulty. Academical scenario, question will give you table value, present value factor or annuity factor for two different rates. Suppose the question is giving you that rate for like, no, it is given as 15% and say 18%. Now, you take the PV factor value at 15%, you'll be getting discounted cash flow. Similarly, 18% of PV factor as given in the question. Question would have given this table value. Which two rates I should take? Should I start with 10%, 20%? Question 2% will be given. That percentage you take, you will get discounted cash flow. Then interpolate, my dear friends. You will be getting the number. You will be getting the computation, how to calculate the interest. For example, at 18%, see it is coming to it is some 39,000 and all. 39,000 and all. It is not an accurate number. I'm just telling you some assumed number. At 15%, my dear friends, at 15%, at 15% is 39,000. At 18%, say it is around 34,000. But we know that it is within the range of 15 and 18, that 36,000 lies. 36. We want 36,000. How to interpolation alone, all I'm explaining, my dear friends. At 15%, it is 39,000. So 39 minus 36 divided by 39,000 minus 34. That is from 39 we are starting and we should reach 36. That is the numerator. Denominator is difference between these two rates with a rate interval of 3%. With a rate interval of 3. What is this 3? It is 18 minus 15. Suppose you start with 15 and 20 now, then it is rate interval of 5. So this is the computation for computing that interest rate. So it is the rate at which installment value, if discounted, should be equal to principal portion. That is cash price minus cash down. Once you find out that interest rate, then you prepare this simple table in computation of interest. Year, interest payment, installment, principal outstanding. You know it is 36,000 as given the question. First year, by using the rate what you have calculated. So highly anticipated question from this segment is the interest calculation problem, my dear friends. So prepare further question, my dear friends, about interest calculation. So this computation based question only regularly will come. Last time they have already tested the repossession, my dear friends. So the basic point of repossession is that if there is any default committed in installment, obviously hire vendor will repossess the asset. In our books, in the books of hire purchaser, you will have asset account, you will have hire vendor account. Say asset shows 80,000 and hire vendor shows say 70,000. So then this asset they are repossessing it. At the time of repossession, imagine they are fixing a value of 65,000. In that case, hire vendor debit 65,000. We call this as agreed value. Not asset value, not liability value in our books. It is called agreed value, for which separate information will be given in the question. Credit asset, how much na? 80,000. Difference is called loss on repossession. So, which will be obviously debited to P&L account 15,000. In the books of hire vendor, accounting is so simple. It is goods repossessed 65,000 to hire purchaser 65,000, which means You will have profit or loss on repossession for higher purchaser, but higher vendor, at that time there won't be any profit or loss. He will either service, recondition, repair this asset, say incurring an expense of rupees 3,000, he will make an entry, goods repossessed to cash, 3,000 rupees. Our repossessed goods becomes now 68,000, and imagine he's selling for 72,000, bank account debit 72,000, goods repossessed now how much value in the books? 68,000, and he is having profit on sale 4,000. Suppose he is selling for some 61,000, means he is having a loss of 7,000. Like that, the vendor will have profit or loss not at the time of repossession, only at the time of resale of the repossessed goods. A very basic accounting for the goods repossession and subsequent sale, my dear friends. Okay, in the books of hire purchaser, debit the asset at agreed value, debit the liability at agreed value, credit asset at book value as given in the question. Difference is profit or loss on repossession. But for hire vendor, at the time of repossession, goods come into the books, there will be some expenses incurred. At the time of resale only, profit or loss or sale is recognized. These are the basic accounting for hire purchase transaction. Highly anticipated problem area is computation of interest when either interest rate given or interest rate not given, my dear friends. So with this, we are also now putting an end to hire purchase chapter. Now we are moving on to the next chapter, single entry or incomplete records. From an incomplete records viewpoint, there are two problem areas. One is called statement of affairs method problem. The other one is called conversion method problem. Conversion method problem. We completed close to 1 hour 20 minutes. In this, so far we covered somewhere around some 60 to 70 hours chapter. Let's proceed. In incomplete records, we don't have many concepts to be discussed. If it is statement of affairs method, the problem normally involves preparing opening SOA, asset, liability, capital, balancing figure. Assets and liability should be given in the question. Preparing closing statement of affairs, where again you will arrive capital as balancing figure, then closing capital, addition of drawings, deducting additional capital, deducting opening capital will give you profit or loss. What is the concept? Concept is closing capital, opening capital, difference should be profit or loss. But there will be difference due to drawings and additional capital, which we are nullifying. Had the drawings not taken place, had the additional capital not taken place, what would have been the closing capital? Now, when we nullified and when you compare it with the opening capital, difference is only because of profit or loss. Very simple concept. Under conversion method, we prepare trading account, we prepare P&L account, we prepare balance sheet. For this, we need adequate information. Many information will be missing. Just to ensure that none of the information is missing or information is complete in all aspects, we prepare certain working notes. Generally, or minimum 4 working notes required, which is opening balance sheet or opening statement of affairs, a simple cash book to confirm all cash transaction. To confirm credit transaction, we prepare debtors and creditors account. So a cash book with cash column, cash bank, opening balance sheet, debtors, creditors. We prepare this. In these 4 accounts, why are you going to prepare this now? Anything could be missing information. Generally, cash book, either cash balances or cash sales, cash purchase could be missing information. Debtors account, either opening debtors or sales. I won't tell this is a missing information because this examiner gives different things as missing information. But these are all the general 4 workings. So there will be inputs for you to present these workings and also to prepare trading P&L balance sheet. With available inputs, first you go for simultaneous posting, balance these accounts, find out what is the missing information, post those missing information into your financial statement, and it will get tallied. So I can't explain much beyond this because every type of question will be new in single entry. But the overall concept is that you will have 4 workings, and sometimes there is negotiable instruments like bills transaction. Additionally, we'll prepare 2 more workings called bills receivable and bills payable. So open either 4 workings or 6 workings, find out missing information, post that into trading P&L balance sheet, and it should be completed in that aspect, my dear friends. So this is how the problem areas, no much concept to be discussed. Only by way of practice and the basic accounting flow, you can solve that particular topic, my dear friends. Nothing that I can recap like different concepts, no concepts here. It is giving missing information, you are finding missing information by preparing either 4 working or 6 workings. Sometimes they will give you simple ratio information. They will give previous year gross profit 70,000, previous year gross profit ratio, say they give like say 30%. Based on this, what we can do now, and they would have given sales in the current year increased by 40% as compared to previous year. Like that they are telling now. About using this, you should know how to compute certain things. So what is that? Last year sales into GPR has given you last year GP. So 70,000. So X into 30% gives you this 70,000. Thereby, my dear friends, you can find out what is the last year sales, my dear friends. So it is 70,000 divided by 30%. So that way we can calculate this. Suppose it is 90,000, 90,000. 90,000 divided by 30%. Like that, when you compute now, you can get last year sales as 3 lakhs. And current year it is increased by 40%. 1,20,000. Our current year sales 4,20,000. Like that, sales computations and all will be given like this simple information. Similar, another type of information is that they will give something called debtors velocity, or they will give debtors credit period. Both are one and the same. And if it is mentioned as 2 months, and 31st March 22 debtors balance given as say 3 lakhs given. From this information, if no other things conveyed, we can find out by making certain assumption. What assumption? Sales were uniform throughout the year. This 2 months is the credit period, means this 3 lakhs represent last 2 months sales. This 3 lakhs represent last 2 months credit sales. We can find out credit sales of 21-22, not 22-23. In the debtors represent closing debtors of last year. With that we can find out last year sales. So 3 lakhs representing 2 months sales. What is for 1 month? Divided by 2 into 12 months. So you will be getting, my dear friends, 18 lakhs as last year credit sales. And if the question tells you sales increased by this much percentage, based on that, you can find out current year credit sales. And if they given a relationship between current year credit sales and cash sales, so some 20% of total sales is cash sales, like they're all given now. Using that, we can find out cash sales. So and post in the relevant place. Cash sales in the cash book, credit sales in the debtors account. And the simple computations also involved. Without the help of ledger account, you find out sales purchase information, closing stock, cost of goods sold information. So you should know basic cost of goods sold equation. Either it is opening stock plus purchase minus closing stock, or it is sales minus gross profit. Using these simple equations, they may ask you to find out certain missing information. The same is applicable for cash flow statement also, my dear friends. So otherwise, it is preparing either 4 workings or 6 workings, my dear friends, is how you complete incomplete records. at a single entry problem area, my dear friends. Latest 2-3 RTP problem is sufficient for your preparation. So for all the chapters, I would say during the last few days to come, so you practice at least minimum 3 RTPs, 2 suggested answers. You should practice at least in the last 3 days. This should be a preparation base for your examination. With that, very confidently you can face many of the questions, because all the areas are covered. At least if you take all the 3 RTPs and 2 suggested with the remaining time. If you cover more, it is well and good only. It's not a rule that it is only this, but minimum this much you should be covering. So we are just completing the 4th chapter of our module 3. Now we are going for the branch accounts. So 9 we should be completing this module 3. So then we can go to module 2 and complete those 5 chapters in module. From our viewpoint, it is 6 chapters. Okay, so we are now focusing on branch accounts. First of all, we have listed out the entire chapter syllabus and all. As far as branch accounts is concerned, my dear friends, we have problem areas which is based on dependent branch, independent branch, foreign branch. Under foreign branch, there are 2 problem areas. One is called integral foreign operation, non-integral foreign operation. Independent branch, primarily the problem area is, one is preparing final accounts of head office, branch, and maybe overall business. And certain entries, some unique entries, independent branch problem areas. Dependent branch problem areas, my dear friends, we have debtor system, stock and debtor system, final accounts method, wholesale price method. Like that, we have 4 problem areas. So these are the problem areas 4 to 6 plus to 8. And the Mari, you have 8 different problem areas in the syllabus. Last examination, we had a foreign branch problem for 5 marks. We anticipated for 15 marks, it came for 5 marks. Before 3 times they were testing this stock and debtor system. Above, there could be high chance now this time, either it could be a data system problem or it could be an independent branch final accounts method or maybe an entry problem. So high chance independent branch problem is there. Generally students have some discomfort in the independent branch. Anyway, so let's quickly discuss about the various concepts that we have in branch accounts, my dear friends. Dependent branch means, primarily we understand dependent branch means branch accounts maintained at head office, which means head office maintaining head office accounts. Accounts means accounting for all transactions and events, and head office also making accounts for transactions of branch also, to find out obviously profit or loss of the branch. So you have a method called debtor system, whereby head office treating branch as its debtor, branch as its debtors. So normally when you prepare debtors account, what you'll be having, like opening balance. You will have whatever goods sent, which is nothing but sales. You will have various forms of collections. You will have closing balance. Same way, in the books of head office, they prepare just a single account called branch account, and in which whatever money receivable from branch will be there as opening balance. What do you think the money receivable from branch? Whatever things present at branch are nothing but receivable by head office from branch. So, in other words, branch or net assets. Branch or assets are very particularly branch net asset, branch stock, branch order debtors, whatever cash and bank balance available, PPE balance any available, any liability deduction, this net asset of the branch is receivable. Though normally we have stock debtors cash balance, you may also have PPE, you may also have liability. So whatever net asset available at the branch is receivable by head office. You are my debtor. Then I will record also the transaction that takes place between you and me. That's all. What you do with third party, I don't record. Which means in this system, we'll account only the transaction happening between head office and branch. So I sent goods to the branch. I give some cash for meeting their expenses. Either these expenses I will pay to the branch so that branch can give it to some third parties, or I will give directly to branch employees, branch landlord, etc. So I'm paying some cash on behalf of you or directly to you. So those things also, what I give is receivable from you. And if you already given some cash, and sometimes whatever goods I sent may be returned, you also given me cash, we call this as remittances, and we will have closing balance of the net assets. These are the only things that will be posted here. Opening balance, closing balance of net assets. I send goods, some goods returns. I send cash and I will also have cash remitted. These are the only posted. Which means cash sales happening at branch, not relevant. Credit sales happening, no relevant. Bad debts, discount allowed, sales returns, nothing. I will be accounting in my books. By accounting these things, I can easily find out profit or loss. What I gave it to you, what you gave it to me, what is still opening receivable, closing receivable, this is sufficient for me to get the profit or loss. The only thing is the stock information will be at a invoice price. Invoice price. Invoice price, stock information, invoice price. Those stock which are at invoice price should be converted into cost price by removing the profit margin. So by stock reserve opening, the profit margin relating to this opening stock. To stock reserve closing, profit margin relating to closing stock. There is also goods sent, goods returns. So I will remove the margin relating to net goods sent to branch. For example, I sent to 1 lakh units. They return 20,000 units. So I should remove the margin only on 80,000 units. That is what, again, removal of loading on net goods sent to branch. So once that removal has happened, the difference is nothing but profit or loss. Profit or loss will be balancing figure. So I'm discussing this because I anticipate there could be a problem onto data system. Presentation of simple branch account, latest RTP also suggests so. They gave the problem involving a simple presentation of branch accounts. So the branch account and the data system prepared by the head office will have these information. What and all? Opening balances of branch assets, closing balance of branch asset, goods sent, goods returns, cash sent, cash remittances, and then the conversion of stock information at invoice price into cost price. Even if the question says about bad debts, ignore. Loss of stock, abnormal loss, ignore. All those things automatically accounted because I am considering opening balances and closing balances. Other bad debts, abnormal loss, everything automatically accounted. So profit or loss, it is not that I don't want to account bad debts. It is that it is automatically accounted. Like that, we complete this data system, my dear friends. If it is going to be final accounts method, head office will prepare a branch, trading and P&L account. There is no separate balance sheet and all, trading and P&L account, where you will have opening stock, purchases, sales, closing stock. Only thing is all these things are cost price. Even though questions might give invoice price, you should know how to convert the invoice price into cost price by using the margin given. Sales actual, you will get gross profit, and gross profit, various expenses of the branch that includes salaries, rent, bad debts, everything. You will be having the net profit. Simple final accounts method. Simple final accounts method. Now, stock and data system, my dear friends. Stock and data system means detailed accounting will be made by the head office in relation to branch, which means head office will account the transaction made by head office with branch as well as branch made with outsiders like cash sales, credit sales, collection from debtors, bad debts, discount, sales returns, abnormal loss, normal loss, everything will be accounted under stock and data system, but still arriving at same profit or loss that we will get by preparing single account also. So what are the accounts that we will be preparing under stock and data system now? Branch stock, branch debtors, branch cash, branch expenses, branch adjustment, branch P&L. One more account normally prepared is goods sent to branch account. Like that, we'll be preparing 7 accounts. Stock, debtors, and cash generally will have opening balances. The gross profit is routed through this account called branch adjustment. The moment you have opening stock, which is recorded at invoice price, profit relating to that will be accounted in the branch adjustment account, either as by stock reserve or as opening balance, the profit margin relating to opening stock. When you send the goods, my dear friends, again what you record is invoice price here. The related profit margin is accounted through adjustment. So adjustment account shows profit relating to total goods available at the branch. And then when you make sales, sales will be simply credited in the stock account and also in the relevant debtors account or in the cash account. At that time, profit account, that is adjustment account, is not affected. When you arrive at closing stock, the profit relating to closing stock will be carried forward as stock reserve to future. Balance is the branch profit transferred to branch P&L. So in the branch P&L, you will have the gross profit. These expenses, if any, will be transferred to branch P&L. You will arrive at the branch or the net profit. The same profit that you arrive at by preparing single account will be arrived by having comprehensive accounts. Why they complicate things there? Because they will have control over stock, debtors, cash information. They will maintain complete accounts. It takes a lot of time for me to explain all the journal entry and all. The basic concept is profit is accounted through adjustment. Relating to profit to opening stock and goods sent will be accounted. When you have closing stock related profit is carried forward. Up remaining profit represent profit on goods sold. Profit on goods sold. Similarly, this branch stock should tally. If it is not tallying, due to credit is greater, it means the sale is happening at more than the invoice price. The entire balancing figure is also profit, which can be transferred to branch adjustment account, which can be transferred to branch adjustment, because up to invoice price there is profit. If it is more than invoice price, definitely there is profit. That concept only is the basic concept I can recall. If you already studied, then you will definitely understood all these things. Otherwise, you should practice. I'm not giving much elaborate discussion because for 3 examination we had this problem area. So directly I move on to the next segment discussion, independent branch problem. Independent branch problem, topic. In the independent branch problem, my dear friends, simple accounting entries and final accounts. Preparing final accounts of head office, from head office trial balance. Preparing final accounts of branch from branch trial balance. Preparing overall financial statements which combines the information of head office and branch. Which combines the information of head office and branch. Sorry. Ipo, entries wise, what is the basic entry? Na? You will have here independent branch means accounts maintained by head office, accounts maintained by branch. That is, head office accounts, head office will do. Branch accounts, branch will do. That is what independent. Branch accounts, branch will do. Branch will have journal, branch will have ledger, branch will have trial balance, branch will have final accounts. So if such accounting is made, entries relating to transaction between head office and branch, my dear friends, one thing is that whenever head office debit or credit branch, branch also will do the opposite, credit or debit head office. For example, head office sending goods, entry will be branch to goods sent to branch. Head of branch books, we are receiving goods, no, goods received from head office to head office. Upon head office debited branch, branch credited head office. The same thing will happen when they give cash, head office giving cash. That party is called branch, branch to cash. Branch is receiving cash, no, cash debit, credit head office. So like that, you find that debits and credit automatically made. Upon we expect something, my dear friends, what we expect now? In the head office books, generally branch shows debit balance, and branch books, head office will show a credit balance. This shows money receivable and this shows money payable. And this amount are expected to be same. These amounts are expected to be same. Now, sometimes there will be difference. First of all, why the amount has to be same? It should debit here, credit. That is okay. But amount should be same. Why amount should be same? Because same number is recorded in both the books. Amount has to be same. But sometimes the amount is different. The difference is caused because of either errors or omissions. Either it is error or omission, or it could be because of transit items. Or it could be because of transit items. What do you mean by transit item? Sir, head office had sent goods for which head office made entry. Branch have not received the goods. Branch is located at say Kashmir. Head office at Kanyakumari. Still it is in Madhya Pradesh only. So at Kashmir goods not received. So they have not made journal entry. So obviously until the time it reaches the goods there and make entry, there will be differences. That is called transit items. Or branch have remitted cash either through a draft or through some bank transfer which on a particular date is not credited into head office bank account. So that is what we call it as either goods in transit or cash in transit, transit items. Errors or omission, either in some books, some error is committed. So head office have made one transaction, made entry for that, branch failed to account the transaction. That is called error or omission. Now, in such case, my dear friends, what we should do now? Before you prepare the final accounts, these balances has to be reconciled by making the reconciliation entries. Sorry, where to make the reconciliation entry? Generally, reconciliation entry will be made at the receiver's place. Receiver's place means, suppose head office had sent goods to branch for which head office have already made the entry. Then in that case, branch is going to receive the goods, yet to make entry, make the entry. Upon in the books of head office, branch, so reconciliation entry will be made not in the books of head office, in the books of branch. Goods in transit to head office account. Head office have already debited the branch at the time of sending goods. So here branch will do the reconciliation entry. Suppose if it was branch have remitted some money for which they have already made the entry, head office yet to receive now, then there is showing some difference. No, in that case we should do the reconciliation entry here, cash in transit, or also called as remittance in transit to branch account. It is not branch to cash in transit. So cash in transit or remittance in transit to branch account. So at that time, no reconciliation entry in the books of branch. So that automatically the balances will be reconciled. Before final accounts, this reconciliation by recording the transit items, also rectifying the errors. Errors where to rectify? Adhikku no doubt. The place where the error committed, at that place it should be rectified, my dear friends. So that way, we should be knowing this reconciliation entry, or important segment, you should not forget it. Similarly, one more area highly anticipated is accounting for inter-branch transaction. One head office having branch 1, branch 2, branch 3. Now, between these branches, they find that lot of transaction happening. Branch 1 transferring goods, branch 2 transferring cash, branch 3 transferring goods, like there's some transaction. Then in the head office books, how the transaction should come means it should be accounted as if it is, it should be accounted like debit the receiving branch, credit supplying branch. Debit receiving branch, credit supplying branch. But in a particular month, there is like some 30 different transactions now. 30 transactions, they don't make entry. But they prepare register type. So branch 1, branch 2, branch 3. Then they will make like transactions. So relating to branch 1, supply goods. Apo branch 2, branch 3 is receiving it. Debit the receiver. Branch 1 supplying credit. Apo what you can do is that, my dear friends, you can show credit as positive and debit as negative. Or it could be the other way also. You can indicate like this. Or you can simply mention like this, my dear friends. Suppose 30,000. You can mention like this, debit. 40,000, debit. They are receiving. Branch 1 supplying, 70,000, credit. Branch 1 supply, branch 2 and 3 receive. So maybe goods cash paid or cash received. Branch 1 receiving cash. So from branch 2, 5,000. Branch 2 supplying cash or paying cash. Credit, 7,000, credit, 12,000, debit. Like that, each branch order transaction you should record by debiting the receiver, crediting the giver, and find out net debit or credit. So definitely debit will be equal to credit, and you will give a single journal entry for all this inter-branch transaction. For highly anticipated or 7 or 8 mark question, my dear friends, accounting for inter-branch transactions. So for that, maintain a register type by debiting the receiver, crediting the giver, supplying branch, and find out the net total for which you should be making the entry. We call this as reconciliation entry. Inter-branch transaction entry. You already learned reconciliation entries. Now, preparing simple final accounts, question will give you trial balance of head office branch showing debit, credit, debit, credit. There will be information about asset, liability, income, expense, and there will also be head office account, branch account. Branch account in the books of head office account in the books of branch. So this information will be there. So it is a simple presentation of trading profit loss account balance sheet, having columns like this, head office, branch, and if the question asks you overall business, then it is total column. Head office, branch, total. You will have opening stock, total, purchases, sales. It's a simple posting. Only thing is, there will be a separate income for head office, which represents goods sent to branch, which is expenditure for head office. It is not for branch. I'm sorry. It is income for head office and it is expenditure for branch. Only thing is, for overall business, suppose here sales 5 lakhs, 3 lakhs, so total 8 lakhs. But here goods sent to branch 2 lakhs, nil. Here it is also nil. It is not income for overall business. It's only income for head office. Similarly, the 2 lakhs will come in the expenditure side of branch, but not in the overall business. This alone you should be knowing. Otherwise, it's an easy task of preparing trading P&L. Simple tallied trial balance given. Adile you are presenting trading P&L and balance sheet of head office, branch, and total. About practice 1 or 2 independent branch problem. There is high chance because 4 examination they have not tested independent branch problem. There is every chance they can test this problem, my dear friends. As far as the foreign branch is concerned, it is purely application of AS11 principle. So adukku AS11 I should be taking. So accounting standard segment we are not doing. And in the last examination we had foreign branch problem. So not highly anticipated. So thereby this is what we understand as independent branch problem. Independent branch problem is actually easy from a practical perspective. But question will give generally some missing information like closing stock, which is outside the trial balance item. They are not giving only. Appo, we may have to prepare working note to find out closing stock. That is how it is getting slightly complicated. About how to find out closing stock, say goods available at head office, which comprise of opening stock plus purchases. Then these goods would have been sold, transferred to branch. Appo you may have to arrive at closing stock. Sales will be at selling price, convert into cost price. Goods sent to branch at invoice price, convert into cost price. So that you will get closing stock at cost price. Similarly, branch goods received from head office would have been sold. There may be some abnormal loss. You may have to arrive closing stock as balancing figure. Like that, by simple application of common sense, you can find out those, though we tell simple and all, it's not so simple. So you may have to find out those missing information and you may have to put into relevant place. That is how the problem is getting complicated. Conceptually, it is not. So only thing is you need to have that extra practice of finding that missing information, whatever given, if any. Otherwise, independent branch is a very simple area. If there is no missing information, my dear friends, okay. So that is how we are concluding on to this branch chapter, my dear friends. Proceeding on to now departmental accounts. Departmental accounts. Okay. As far as departmental accounts are concerned, the problem areas are simple presentation of departmental trading account, profit and loss account, also presenting general P&L account. Computation of managerial commission. One specific area called markup accounts and memorandum stock account and markup account. In the Mari, you have 3 problem areas under departmental accounts. Last 3 exam. The question was simple presentation of departmental trading P&L. They will give you departmental trading P&L. Say like A, B, C. A, B, C. Trading related information will be given. Opening stock, purchases, sales, closing stock. And the information simply pick up and post. You'll be getting gross profit. Gross profit amount will be taken into P&L. There will be some expenses given, but not for each department separately. There will be most of the expenses are common expenses. Salaries of all departments together, rent of all departments together, interest of all departments together. Like that, they would have given depreciation and all. Well, you should know how to apportion those expenses. So salaries, rent. How do I apportion, sir? Their question only will give. The question only will give the basis for apportionment, but they won't tell which base for what expense. Salaries, they will be giving you question. There will be definitely information about salaries, 5 lakhs, rent 3 lakhs, like that will be there. Some additional information they will give: number of employees, space occupied by each department, department A, B, C. So then lighting points, like that, a lot of information will be given. What you should do is that which number should be apportioned on which base, you should be in a position to connect. It's simply like match that by at your level. Easily you will do, because ABC costing and all you are done. So that much and all not there. Simple matching, my dear friends. About total expenses will be apportioned to various departments on some basis, for which you need not, it's not even like profit or loss pre-incorporation, where you will be computing something called time ratio, sales ratio concept and all. There will be some basis mentioned. On the basis like you should be apportioning, my dear friends. And the apportionment expenses, you will be finally ending up in net profit of each department. You will have net profit of each department. Now, what is that in general P&L? I will tell you, my dear friends. General P&L, having taken net profit of all these departments together, there is some unrealized profit here. What is unrealized profit? It is because Department A make only sales to outsiders, no problem. But Department A transferring some goods to B, which is booked as income of A, expenditure of B, and B would have transferred some goods to C, which is income of B, expenditure for C. Those profit portion is also included in the net profit. If transferred goods by A to B, had it been sold to third parties, no problem. Then it is realized. But if A transferred goods to B and still it is there in the closing stock of B, or B is transferred goods to C and it is still there in the closing stock of C, then we have organization as a whole something called unrealized profit, which should be removed. Stock reserve closing. Similarly, if there is some profit margin related to opening stock that is removed in the last year, that becomes profit in the current year. So opening stock reserve, current year net profit minus closing stock reserve will be the net profit realized of the organization. So which means computation of opening and closing stock reserve. How to compute? Very simple. Take the relevant stock, apply the relevant margin. So only thing is, stock normally valued at cost price, but my selling price is your cost price. When you apply the margin, and the margin on selling price or transfer price should be applied. Question may give margin on cost price. You may have to convert the margin in terms of selling price. We'll be doing this right from foundation onwards. Consignment chapter and all, it was there. So the same thing only applicable here. Find out stock reserve by applying the appropriate margin. Why do you say appropriate margin? Sometimes question will give directly margin on sales. Directly multiply. Sometimes margin is given on cost price, then convert that margin. Suppose it is given as 30% on cost price. 30 by 100 on cost price equal to 30 by 130 on selling price. Find out the margin and find out the stock reserve. Easy. But this is one difficulty. Suppose we take B on a stock and we know A's margin is 20 or 30% on cost. 30% on cost. But no doubt we know B stock into 30 by 130 you should apply. But imagine, my dear friends, in the B's cost consists of some purchases made by B directly, which we call as own cost. Then transfer from A also. Transfer from A. Our cost consists of two components. Our own cost does not have any profit margin. Only transfer from A has got profit margin. So the point is, the closing stock which is available at Department B will also have own cost of B transfer from A, both the components. In that case, what you should do now, these B stock, before applying the margin, you should apportion into own cost and transfer from A. How I apportion? It is in the same proportion of own cost incurred in the current year and transfer from A made in the proportion closing stock should be apportioned. Then, my dear friends, margin should be applied only on the transferred portion of closing stock of B. This concept you should be knowing. If there is no own cost incurred by B, no own purchases by B, then no problem. But if there is own cost, then you should apportion, then margin should be applied only on the transferred portion. So in some problem, on the entire goods application comes, some problem, this apportionment comes and the margin should be applied. This is the only little complex part which you should carefully do. So apply your mind and apply the computation of margin. Explain the basic format of trading P&L. Another concept. Department A, Department B. Transfer goods to Department C and D. A will transfer to C and D, B also transfer to C and D. Like that transfer is there. For each of this transfer, margin is there. Now question says, all the departments manager entitled to 10% commission of departmental profits. Departmental profits. And always it is implied that it is departmental realized profits. Departmental realized profit. So in that case, the departmental profit should be arrived by after deducting the stock reserve from the concerned department. So though in accounts we normally deduct from general P&L, but if the problem involves computation of department manager's commission, then stock reserve should be deducted from concerned department. So anga careful, you should know two principles. The stock reserve is computed based on transferee stock and eliminated from transferor profit. Really, sir, not understanding. You should compute the stock reserve based on C and D stock, because A and B are not transferee, A and B are transferor. So C and D only will have stock. Take their stock and compute the stock reserve, deduct from A and B's profits and find out the revised A and B's profit. On the revised profit only, apply manager's commission. Suppose manager's commission already they have deducted, reverse manager's commission, then adjust the stock reserve, then recompute the manager's commission. This is one problem area that is also highly anticipated. Finally, we have this memorandum stock. Memorandum markup. It's the same concept of branch. Goods are accounted in a centralized manner where when you have opening stock, recorded selling price, goods sent to goods sent to the departments, recorded selling price. But what happens now? Stock will be recording stock at selling price. Related profit margin is what we call as markup. So you will be having opening balance, which is profit relating to opening stock. You will also have profit relating to goods sent in the current year, goods transferred or purchased, sent in the purchase in the current year. In the stock recorded selling price, related profit margin recorded in the markup account. When you make sales, sales simply credited in the stock account. It is anyway, these are all selling price, sales to selling price. Then you will have closing stock, which is again at selling price. What we should do now? Related profit, which is carry forward in the markup account. Obviously, the balancing figure in the markup account represent profit relating to goods sold. This is the profit on opening stock, profit on goods purchased, total profit anticipated. This is the profit relating to closing stock. Our balance naturally should represent profit on goods sold in the current year, which is transferred to P&L account, So this is the gross profit relating to goods sold. So in the basic concept. Now, in the whole accounts lab, there is an item called marking down event. Marking down event. What is a marking down? Now, see, some goods whose purchased value was 10,000, whose expected selling value was 15,000, whose profit margin recorded here as 5,000. Now, what happened now? Maybe due to competition, due to festival season, we already decided to reduce the profit by 1,000 or reduce the selling price by 1,000. Reduction of selling price is called marking down. During their markdown by 1,000, like that told na, then obviously that should be deducted from stock figure, also deducted from profit figure. So thereby the markdown will be credited in the stock account, also will be debited in the markup account because that profit is not going to be expected. So that is called marking down event. That simple accounting the people will complicate. Similarly, if some goods are abnormally lost, that also should be eliminated from stock account at selling price. Related profit margin should be deducted from the markup account by debiting the markup account. So because of abnormal loss, this profit will not be realized. Like that, when the goods sold, we need not do anything. We book the profit on opening stock. We book the profit on purchased goods. We remove the profit when the markdown happens. We remove the profit when the goods are lost. We carry forward the profit relating to unsold goods. Balancing figure represent profit on goods sold in the current year. Transfer to P&L. The whole concept of markup, markdown. One problem to be solved now, it will take 45 minutes. Then many chapters only can't be recapped. So with this, we are concluding on to module 3, 6 chapters. So 120 hours we have completed. For 2 hours left, 2 hours 10 minutes left. For 120 hours of regular session we have completed. Now we are moving on to module 2, my dear friends. Module 2. Module 2. Let me start with simple chapters. I told you from my viewpoint 6 chapters, Reddy module 5 chapters. So adala buyback, bonus and rights issue, one small topic. Regularly comes for 5 marks. Bonus and rights issue. From a bonus viewpoint, they will ask you, they will give you a balance sheet of a company, or they will give you some data about information about bonus issue. They will ask you simple journal entries. Basic entry is reserves to bonus to equity shareholders. It is just converting reserves into share capital. Capitalization of profits. Bonus to equity shareholders to equity share capital. Entry is over. Entry completed. So reserves to bonus to equity shareholders, equity capital. Journal entry over. 5 marks. Question will give you share capital of the company 5 lakhs. Company declared 1:1 bonus. About 5 lakhs bonus. Reserves to bonus to equity capital. Suppose they may have ask you to prepare the revised balance sheet of the company. Then include this bonus amount. Provide that shares issued for consideration other than cash. That is for bonus. That disclosure is required. That's all. Very simple topic. Now, reserves, my dear friends, normally the available reserves are, and also in the order of preference. There is no rule or law that this order should be followed, but general applications this order. What order? Na? CRR, securities premium, capital reserve, general reserve, profit and loss account. This is the normal order that we assume for utilization of reserves for bonus. Why? Because capital redemption reserve is a reserve that can be used only for bonus. If you don't use, then it can't be used for anything. That's a dummy. When you get opportunity, use it. Securities premium can be used for bonus and also for another few purpose. So it is also having limited application. This have got only one application, so use that first. This also have limited application, so thereby use securities premium next. Then you have capital reserve, realized, you can use that. Then we will have general reserve, P&L account. So P&L account, which can be used for all purpose, so use it at the end. Sir, can the company have different order? Practically, yes, very much. So, as an examination perspective, this is the order in which we follow. If this much is sufficient for to give that bonus of 5 lakhs, then you don't use general reserve period. There is no proportionate usage and all. I'm telling you 5 lakhs required. CRR has got 3 lakhs, securities premium 1.8 lakhs, and you have a capital reserve of some 2 lakhs available, then use only 20,000. 20,000. Don't use general reserve, don't use P&L. Like that, you should be in a position to decide which reserves to be used and which is not getting used. This is one point. Sorry. Suppose, my dear friends, you are giving bonus in a scenario where the shares are partly paid up. So, equity share capital of rupees 10, rupees 7 paid up, rupees 7 paid up. In this case, the company wants to give 1:1 bonus, means 1 share for every 1 held. They have 10,000 shares. They want to give bonus. First, the 7 rupees should be made into fully paid. Because we can't give 7 rupees bonus share. We can't give partly paid bonus share. But thereby, my dear friends, 7 should be becoming 10 rupees. That will become either by we receiving 3 rupees from them, or that 3 rupees also we are giving bonus. About 2 types of bonus. Conversion of partly paid into fully paid, then giving fully paid bonus. So 10,000 to 3 rupees or 30,000 bonus, then 10,000 to 10 rupees or 1 lakh bonus. In the 30,000, CRR, securities premium cannot be used. So you should use, obviously, capital reserve, general reserve, P&L account only. So we can use only for fully paid bonus share those reserves, my dear friends. If the question has got conversion of partly paid into fully paid, then obviously you have to use other than securities premium and CRR. That can be used only for fully paid bonus. Nothing beyond this in the bonus topic. Easiest chapter. Rights issue, it is not going to be accounting entries and all. There is a simple computation about concept of value of right. Also computing the value of share after right. Value of share after rights. I directly demonstrate with the help of some numbers, because highly anticipated question this time in relation to this rights calculation. The similar computation you do in group 2, one of the accounting standard AS20 EPS. So, how to compute that, my dear friends? Suppose Mr. J, who recently purchased 1,000 equity share at rupees 80 in the market. Now, company is offering another 600 equity shares at rupees 50 rupees, which is the rights issue. Rights issue. Now, we calculate something called expected value after rights. It is also called theoretical ex-right price. Expected value after rights. How to calculate means 1,000 into 80 was the net worth before this subscription of this particular rights. Then additional shares acquired by payment of 50. Now, this is the whole value of the shares. This was the value before the rights. This is the right value, which will be divided by 1,000 plus 600. Total number of shares after rights. So, it is number of shares into market price before rights plus number of right shares into right price, exercise price, divided by total shares. So, it is 80,000 plus 30,000 divided by 1,600. So, it is 1,10,000 divided by 1,600. So, 1,10,000 divided by 1,600. A calculator I couldn't see. Anyway, so you will calculate the value, my dear friends. It is 1,10,000. So by 16. So you find that 16, 6 are 96, 140. So 8, 68 point and all, you'll be getting some value, my dear friend. 68 point some value you are getting. So this 68 point value, we call it as expected value of the share after rights. Now question is also asking, what is the value of right? What is value of right? Very simple. Market price before the right 80 and expected value after right is some 68 point something. So say imagine 68.25, just assuming. In that case, the difference 11.75 is called value of right. So how to calculate the expected value after right, I have taught you, and the difference between the market price before and the expected value after, the difference is what we are understanding as value of right. Is also a potential examination question, my dear friends. We have completed one chapter from module 2. So just quickly discussing about profit or loss prior to incorporation. Profit or loss prior to incorporation. Okay, so my dear friends, profit or loss prior to incorporation, it is like this. A company originally scheduled to take over, commence its operation, my dear friends, from a particular date. Take over a business from a particular date. A company formed to take over a running business to be taken over from a particular date. But due to some technical problem, the incorporation took place on a later date. Company's birth taking place on some other date. So company have scheduled to take from 1/4/2022. Unfortunately, incorporated by 1/7/22. 1/7/22. Because the company is giving consideration based on the position on 1/4/22. So 1/4/22 onwards, whatever profit belongs to the, whatever profit generated by that business belongs to company, which means entire 12 months profit belongs to the company. Why, sir? Because we are giving consideration based on the position existing on 1/4/22. So even though business continued after 1/4/22, but the company could form only by 1/7/22. So incorporation took place actually by 1/7/22. So 12 months profit belongs to company. But and the 3 months profit, so this Companies Act considered not as an earned profit but as an acquired profit. Like how you acquired the asset, it's an acquired profit, and thereby it cannot be used for dividend purpose. It's not freely available for distribution. It's getting the nature of capital related profit or loss, and thereby such profit will be credited only to capital reserve. Will be credited only to capital reserve, my dear friends. An acquired profit or loss, so naturally the adjustment goes as goodwill or capital reserve, and it can't be considered as a revenue nature profit. Post incorporation profit, say profit related to 9 months, which will be considered as the our own profit, which will be considered as net profit, which is freely available for dividend. Is the basic concept, which means 12 months profit belongs to company but has different treatment for pre-incorporation and post-incorporation, different treatment. Now it is our duty to segregate the profit, apportion the profit into pre and post. But it is not that easy. Like, no, I'm directly giving you 12 months profit, 1,20,000. That easily I am saying 3 months 30,000, 9 months 90,000. In the Mari, apportionment possible only if the profits are evenly earned throughout the year. Sorry, why not the profit be even? If the profit is even, you make assumption na, you understand various incomes are even, various expenses are also evenly spread out throughout the year. Appada, this profit is also evenly spread out throughout the year. Hope you're understanding. But actually, the incomes, various expenses need not be even in all the months, all the days, etc. So thereby, what we should understand is that we should apportion the incomes, expenses separately into pre and post. Income le no big deal. ஒரு sales amount தான் basic income, which can easily be apportioned to pre and post by you working out something called sales ratio. There are many expenses which is same for all the months. So thereby we can easily apportion that expenses on a particular ratio called time ratio. Thus, what is that we are going to do in this topic now? Apportionment of various expenses on the basis of sales ratio, time ratio, direct allocation. There are certain things we understand by reading itself. It is exclusively pre, exclusively post. Like that, we'll understand direct allocation. We'll also have something called specific allocation. For example, there is something called debenture interest. Debenture, now it is something can be issued only by companies. Before the incorporation, company cannot issue debenture. But debenture interest is there for 12 months given. No, we automatically understand it is only for 9 months because it can be issued only by companies. Okay, so the question has given you 12 months information. You should apportion into 3 months and 9 months. In the and the debenture interest, nothing in pre, fully post. Managing director salary or proprietary business, managing director concept. So thereby, you will be directly taking that in the exclusive post. Like that, you should know. There are many items that vary with sales, like bad debts, advertisement expenses, all these things vary with sales. So you will be apportioning on the basis of sales ratio. There are many expenditures that vary with the time. This is 3 months, here 9 months. Above 3 months expenditure, 9 months, 12 divided by 12 into 3, divided by 12 into 9, like that. Direct allocation, I told you. Specific allocation, some expenditures will be there, which doesn't vary with sales or time. It relates to pre and post, but not on the sales and time. So you should consider the facts of that information. For example, my dear friends, your rent information given as 4,80,000. We know time is 3 months and 9 months, but they are telling like, no, there is some additional space that has been taken, and for which after the company's incorporation, additional space was taken, for which rent of rupees 1,20,000 was paid. Upon the rent of 4,80,000, we understand exclusive post 1,20,000. Remaining 3,60,000 is not exclusive pre, it's an additional space. So this is for 12 months, about 3 months and 9 months. Like that we should take. About 3 months 90,000, and this is 2,70,000. About 2,70,000 plus 120, it is 3,90,000 is the post and 90,000 is the pre. This is called specific allocation by considering the facts. Sometimes interest, they will give some specific information. Using specific information, allocating to pre and post, not in the proportion of time or sales ratio. So like that, we have 4 different bases for allocation. Allocate these incomes and expenses into pre and post. You will be getting, comparing with incomes and expenses of pre and post separately, you will get pre-incorporation profit or loss, goodwill or capital reserve, post-incorporation profit or loss, taken as profit or loss only. Like that, we understand this concept, my dear friends. Hope you are following this. Okay. So this is the profit or loss prior to incorporation. With that, we are completing second chapter. 2 more chapters completed. Next, coming to financial statement of companies, which is purely a format driven. In the last examination, we had SOPL, statement of P&L tested. About the broad problem areas are SOPL, unbalanced sheet, or only P&L, only balance sheet. Adukaprom, dividend and managerial remuneration. So, my dear friends, I want you to go through the dividend computation, which is simple and all, but there is some special provision relating to computation of dividend if the dividend paid out of reserves. If the dividend paid out of reserves. Similarly, we have an area of managerial remuneration which provides ceiling on managerial remuneration in case of profits, in case of losses. In case of profits and in case of losses. Profits, na, it is like, you have 5%, 10%, 11%, 1%, 3%. What is that? One whole-time director, 5%. Two or more whole-time director, 10%. Then whole-time directors, part-time directors, managers all together, overall ceiling, 11%. Part-time director salary, if already the business have whole-time director, then it is only 1%. If the business does not have whole-time directors, the company has only part-time directors, then their ceiling is 3%. These are all not the minimum remuneration. These are all called ceiling on remuneration. And all these percentage are computed on profits calculated as per section 198. Profit calculated as per section 198. 198 profit, na, it is usually the net profit of the P&L as determined in SOPL only. But my dear friends, depreciation should have been calculated as per schedule 2. So company calculated some other depreciation, then that should be reversed. This depreciation should be considered. Then repairs expenditure only of revenue nature should have been considered. So if any capital nature repairs, if it is already charged in P&L, all those things should be reversed. They're all big list in section 198, but basic examination question related areas alone I am discussing, my dear friends. And the profit should be before calculating the managerial commission or remuneration. So it should be the profit before tax, before managerial remuneration. And the profit, you should be applying this percentage. Study model have one problem. Based on this, please solve. If the company is having loss, then this percentage or not will not be applied. Then it will be calculated based on something called effective capital. Effective capital. So where you have effective capital being negative or less than 5 crore, 5 to 100 crore, 100 crore to 250 crore, 250 crore and above. So you have 30 lakhs, 42 lakhs, 60 lakhs, 60 lakhs plus 0.2%, 0.02 percentage of the capital in excess of 250 crore. So those numbers should be, again, you glance through from study module. Very, very important area. Either on the day of exam, 2 to 5 in the morning, revise this and go, because highly anticipated. Because last time they have tested SOPL, before that they tested balance sheet, or it could be a simple problem on the balance sheet also. So financial statement of companies in the percentage, in the losses, I mean, if the manager remuneration, if the company is having losses, idella slab format, no concept to be explained there. So even if you learn now also, it is again, it can easily, you can forget. So thereby I'm not focusing on those numbers to be written and focus more and all. So just revise these slab rate, the manager remuneration rate, just day before exam or on the day of exam, highly important from the coming examination perspective. Okay. So this is financial statement of companies. Balance sheet, you should be knowing the format, my dear friends. You have equity and liabilities. You have shareholders funds, share capital, reserves and surplus, share application money pending allotment, normally not coming, non-current liabilities. You have current liabilities. Under asset side, my dear friends, you have non-current assets, current assets. You should know the basic items fitting into which of these heads and subheads, and accordingly provide notes and present a simple balance sheet. Idella format oriented, nothing that I can explain you in a conceptual manner. So please revise the conditions for payment of dividend out of reserves. I would like to recall those conditions, my dear friends. There are 3 conditions. When you pay dividend out of current year profits, then no limit for dividend. No limit for dividend. When you pay dividend out of previous year profit, which comprises of P&L balance and reserves like general reserve. That is general reserve. If you pay out of previous year profits, P&L balance, again, no limit for dividend. But if you pay dividend out of reserves, then reserves meant for business expansion and maintenance, that amount using paying money for dividend, we want to put a cap on the dividend. So there are various conditions. Condition 1, maximum dividend that can be paid. Maximum dividend that can be paid is previous 3 years average dividend. Previous 3 years average dividend. Maximum withdrawal from reserves. What you can take from reserves. It is 10% of paid up share capital plus free reserves. 10% of paid up share capital plus free reserves. Third, minimum retention is 15% of paid up share capital. What is that meant, sir? Third condition says that after you taking money from reserves, minimum this much should be left in the reserve, called minimum retention. So, though condition 2, condition 3 appears to be different, actually both the condition says how much you can withdraw, maximum. So, third condition also indirectly speaking about maximum withdrawal only. So, the third condition also, it is going to be conveying about maximum withdrawal only. So, just for an example, my dear friends, for example, you have paid up share capital, some 20 lakhs. You have free reserves, some 4 lakhs. If you have like this, my dear friends, then how much you can withdraw? First, you can't see condition 1. Condition 1, use, even though given as condition 1, don't take that condition. So, first, maximum withdrawal, 24 lakhs, 10%, 2,40,000. This is condition 2 application. Condition 3, though it says minimum retention, from that what you derive is maximum withdrawal. They say that 15% of 20 lakhs. So, which is 3 lakhs should be left in the reserve. So, in that case, maximum withdrawal is 4 lakhs is there. From this money you should withdraw. But minimum you should keep 20 lakhs into 15%. 3 lakhs should be left in the business. So, indirectly you can withdraw 1 lakh is what condition 3 says. Apo, if you want to satisfy both the condition, you can withdraw only 1 lakh from reserves. If you withdraw 240, then what is left in the business is only 1,60,000. You are violating condition 3. So, actually, for condition 2 and 3, indirectly conveys how much maximum you can take from reserves. This much is there. This much you should leave in the business. Apo, you can withdraw this much only. Apo, by comparing these two, you can withdraw 1 lakh. Suppose previous 3 years average dividend. Previous 3 years average dividend comes to 1,20,000. You can pay only 1 lakh. But if previous 3 years average dividend is 90,000, you can pay only 90,000. Apo, that last you can apply. This is available. This is payable. Available, payable. Whichever is less, you can pay. So, first see how much you can withdraw by applying condition 2 and condition 3. These are the concepts that has been explained in that financial statement of companies, my dear friends. Fast explain. So, you have to remember this. You can go through very much from the study module. Okay. So, on the Mari, we are completing the 3rd chapter also. Cash flow statement. My dear friends, as far as cash flow statement is concerned, you have 2 methods for presentation of cash flow statement. One is called direct method, the other one is called indirect method. Direct method, indirect method. So, my dear friends, when you have this, it's a running state showing the receipts and payments into various activity. You have operating cash flow. Number one. We have investing cash flow. We have financing cash flow. Under each of these three categories of cash flow, you have receipts and payments. Aggregate of these three should be the difference between opening and closing. So, this aggregate of these three called net increase or decrease in the cash and cash equivalents. So, that when you add to opening cash and cash equivalent, it should match with the closing cash and cash equivalent, which is a reconciliation activity we are doing at the end. So, that way, it's a running statement showing receipts and payment into receipts and payments relating to operations, investment, finance. So that receipts and payments, the net effect of all the three should be equal to the difference between opening and closing. So which we call as net increase. Other opening add and closing match. So that way cash flow statement is complete in all aspects. This is a basic concept. Now under operating cash flow, my dear friends, we take operating receipts, which is generally cash received from sales and debtors. Cash received from sales and debtors. Operating payments for purchases and various other expenses. You will be having operating cash flow before tax. Operating cash flow before tax. Then you have tax payment separately. You will have operating cash flow before extraordinary items. Extraordinary item. You will have extraordinary item. You will have net operating cash flow. Net operating cash flow. Under investing cash flow, generally it is purchase of various assets, investment, sale of assets and investment. Interest, dividend received, that's all. Suppose interest, dividend, my dear friends, 10 lakhs, TDS 1 lakh, actual money received is 9 lakhs. We received 9 lakhs, TDS 1 lakh. AS3 require you to show 10 lakhs as inflow. Even though in your bank only 9 lakhs received, you will show 10 lakhs and you will show TDS as an outflow in that activity 1 lakh. Net effect 9 lakhs only, no sir, correct, but they require you to show interest and dividend on a gross basis and TDS as a separate outflow in the same activity. This you should remember. Financing activity what? Issue of share capital, bonds, debentures, etc. Redemption of the same thing. Loans taken, repaid, interest, dividend paid. These are all the financing cash flow. That's all. So identify these activities. Find out net investing cash flow, net financing cash flow. You will have aggregates. Take the opening as given in the question. The net increase with the opening. If you do, it should be matched with closing. It's again given in the question. Hence reconcile. That is what you prepare the cash flow statement under direct method. Direct method, when you solve the problem, most of the times question will give you all the inputs relating to inflows and outflows. Sometimes question will not give the operating related receipts and payments, in which case you have to prepare debtors account, where question will be given information about opening and closing debtors. They will give sales information. Entire sales, whether it is cash or credit, or record in the debtors account, you will get collection, which will have definitely collection from cash and credit sales. So, credit sales don't search for the credit sales. Entire sales you record. Same way, prepare creditors account, opening balance, you will have closing balance. Purchase information will be there in statement of P&L as given. You will arrive at payment as balancing figure. Like that, you may have to prepare these additional workings. Maybe purchase or sale of asset or investment, you may have to find out by preparing asset or investment account. This is the additional working required. Operating, direct method, this much only maximum workings that may have to be done. Indirect method, then it's a different concept altogether, where we arrive at, we take net profit as a starting base and we say this is the operating cash inflow. If this is operating cash inflow, then all the incomes and expenses we are telling it is operating. But obviously there can be non-cash and non-operating items. So non-cash, non-operating items will be eliminated. It could be plus or minus. Non-cash, non-operating items. So first of all, the net profit, if it is retained profit, means this will be converted into profit before tax, which is by reversing dividends, reserves and tax. By reversing dividends, reserves and tax. Reverse panna, you will get PBT. Non-cash, non-operating item, generally depreciation, amortization, profit or loss on sale of assets, interest received, paid. This is the maximum item. Though we don't have complete list rules and all, but normal item, depreciation, amortization, profit or loss on sale. Profit na minus, loss na add back. Interest received already there in the profit, deduct now. Interest paid already deducted, add back. This is called elimination of non-cash, non-operating item. Then we have something called working capital adjustment, where we take increase in current asset, decrease in current asset, increase in current liability, decrease in current liability as negatives and positives. How do we remember in negatives and positives? Na? Increase in current assets, stock increase. Stock increase. Na? Though we have a lot of good logic behind why it is plus minus, we give you some blind understanding like this, that increase in stock purchase. So money goes out, it's outflow. Decrease in stock, it is inflow. Increase in current liability is inflow, decrease in current liability as you paid money, outflow. Working capital adjustment. Then we will have operating cash flow before tax, tax before extraordinary, and so on. And so on, net operating cash flow. Investing financing will remain the same under direct method and indirect method. Operating cash flow alone will work out like this. My dear friends, in the latest examination, they asked you indirect method problem. We anticipated it came. Once again, they can test you indirect method. There is high chance direct method can be tested also. Latest RTP is having a beautiful direct method cash flow statement problem. High chance it can come in the examination. So please solve that direct method cash flow statement problem from the latest RTP, my dear friends. Okay. So otherwise, we don't have this is again the basic concept and some format. Some concept and some format together combines into this cash flow statement, my dear friends. If the question simply mentions as marketable securities, it is investing activity. Only question says marketable security, which is having 3 months maturity or insignificant risk of change in value. Like that, AS3 terms also used along with that securities. Then it can be treated as cash equivalent. Otherwise, simply marketable securities or simply securities given, quoted investment given, it is investing activity. Current investment, investing activity. Long-term investment, investing activity. Short-term borrowing, long-term borrowing, both are financing activity. Bank overdraft is not current liability. It is increase or decrease will be taken under financing activity. It is not to be treated as negative cash equivalent. Bank overdraft should be taken as financing activity. Underwriting commission paid, financing activity. So like that, you have some classification type question can also can come for 5 marks. So they will give few items, classify into operating in investing and all. Loan given to employees, now operating. Loan taken from employees, financing. Interest paid, received. Paid, it is financing. Interest received, it is investing. But interest relating to loan given to employees, now. So it all the interest treatment depends upon principal treatment. If principal is investing, interest is investing. If principal is financing, interest is financing. Like that, you should be very clear about the interest treatment, my dear friends. Okay. So those classification problems also please go through from the study module about the classification of items into operating, investing, financing. Operate na principal revenue producing activity, investing na buying and selling of assets. Financing means raising of funds and repayment of funds. Okay, so with that we are putting an end to cash flow statement. As far as redemption chapter is concerned, my dear friends, redemption chapter is concerned. Redemption. You have redemption of preference capital, redemption of debenture. Redemption of preference capital is actually easy in an accounting sense. Accounting entry wise, you have preference capital debit. You repay money. Premium on redemption to preference shareholders. Payment due. You make the payment preference shareholders to bank. Premium on redemption is a loss, normally adjusted against securities premium not available, general reserve or P&L account, you adjust premium on redemption, premium on redemption. Then there may be a need for creating CRR. In that case, you will create CRR, my dear friends, from profit which is otherwise available for dividend, general reserve P&L to CRR. And if CRR used for bonus, CRR to bonus, like that entries will go on. This is simple concept. Redemption due entry, payment entry, adjusting premium on redemption, and transfer into CRR. What is the CRR concept? My dear friends, whenever there is a share capital which is reducing, either by buyback of equity share or redemption of preference share, there should be a compensation in the form of some other share capital. If it is compensated by fresh issue of new shares, no need for CRR. Otherwise, to maintain the debt equity, the mix, what we want to do is that if it is, so many people misunderstand CRR, it is for the purpose of redemption. No, it is not for the purpose of redemption. After redemption, and you find there is no fresh issue, there is no increase in share capital, then you create CRR. So which means, suppose preference share capital 10 lakhs, you redeemed 10 lakhs, for that you issue 6 lakhs new equity share capital, CRR requirement is 4 lakhs. But we usually make a simple equation. Face value of preference share capital redeemed should be equal to face value of new fresh issue of share capital. It could be preference or it could be equity also, plus CRR. So by making this equation, so you have to arrive at how much CRR is required. There will be some additional condition that they will state that they want to have minimum utilization of reserves, or they want to have minimum utilization of existing cash and bank, which means they want to have maximum amount raised in the form of fresh issue. And the some terms and condition would have been given. Analyze the terms and condition and decide how much fresh issue to be computed or how much CRR required. Both will not be computed. CRR this much required, so balance fresh issue. So you will arrive, or fresh issue this much, balance CRR. So like that, and the facts should be analyzed, compute that number. Some problem only that computation also involved. Many sums, question will give direct information. They are supposed to make simple accounting entry. Redemption of preference capital is such a simple exercise. So maybe you solve some complex problems and you find total topic is difficult. It's only 1 or 2 questions which will cause trouble in making the computation. Otherwise, very, very simple topic. Redemption of debenture, my dear friends, has got lot of accounting, lot of computations involved. So basically, redemption of debenture, my dear friends, for redeeming debenture, we will plan the amount. We set aside some amount for redemption. So thereby, from profits, we create debenture redemption fund. When you have profit as some 10 lakhs, and from that we create this fund of 2 lakhs, profit 8 lakhs. Profit like the fund transfer. The profit represents some various forms of assets. And the asset, only thing is not earmarked. Any asset is there, which is there in the form of 10 lakhs. But when you want to create fund, and the asset also should set aside. But when you use that asset for making some investment, entry is debenture redemption fund investment to bank. So on the bank lane, we transfer to an investment 2 lakhs. This investment will fetch interest. Normally that interest will go to P&L, but when you maintain the fund, that interest will go to fund. Then at the time of redemption, sell this investment, pay the debenture. This fund will go to general reserve. Basic concept. Now to redeem this debenture, there is another concept of buying own debenture, for which accounting entry will be the same as the investment account entry. So when you buy own debenture, there will be interest associated will be there. So you should know how to make those entries and all. It's not so easy for me to explain, or it's not so easy as I tell you, you can easily learn also. You should spend time to learn those entries and all. Because it takes like at least minimum to make a basic explanation of those entries and all, it takes some 30 minutes and all. So, but it is very similar to the investment. Apply your mind relating the investment account, how we learn, the same principle is applicable there. And you can buy the own debenture and hold it as investment. You can cancel against debentures, So redemption by payment of liability directly, or buying own debentures in the market and cancelling against the debenture. Like that concept exists. Entries version, accounting version, please spend time because it is already exceeding 10. So we have made the best efforts to complete all the chapters. I will also convey one thing in the framework topic, my dear friends. There are different problem areas. One is based on going concern. Other one is based on cash versus accrual method, measurement basis, capital maintenance concept. This capital maintenance, similarly asset liability equation, these two are tested recently. So there could be a problem based on going concern, which means if the business have going concern, you should follow normal accounting principles. If business doesn't have going concern, balance sheet asset should be shown at expected realizable value, liability shown at settlement value, difference should be recognized as gain or loss in P&L based on this concept. So that problem is there in the study module. Please solve the problem, highly important, based on this going concern, my dear friends. Measurement basis like historical cost, current cost, realizable value, present value. One machinery purchase for 1 lakh, that is historical cost. Today, if I want to buy again, I have to spend 1,50,000 current cost. But the used machinery, if I sell in the market, I will fetch only 90,000 realizable value. I can use the machinery and generate profit of 60,000 for next 5 years. So I can fetch profit of 3 lakhs. Our discounted value is 1,70,000, which is called present value. Like that, we have different measurement bases. So adu or glance through, my dear friends. Apo, to the extent possible, we have covered everything based on the time available. All these chapters, recap revision has been made. So with this, we would like to put an end to this revision class. All the best for your examination, my dear friends. Do well with confidence. There is no need for regrets about past, I should have studied better, etc. So nothing can change. Similarly, fear element will not do any good to you. Calm mind with self-confidence and strategical preparation, still you can fetch very good marks in the exam. All of you should get good marks in the exam. All the best, hearty wishes and prayers to you. This is what I can offer to you. Thank you so much. Also thanking SICASA and Institute for making such an arrangement to give the last minute revision to the students. Thank you.
Yes. Thank you so much for the amazing. Yes, sir. Hello. கேக்குதாங்க sir? Hello. 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 கேக்குதாங்க sir? Hello. 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 Hello.
Hello. Kevin.
Yes, sir. Thank you so much for the amazing and wonderful session, sir. It's really an honor to host your session as I'm also your student. Thank you so much, sir.
Yes, I
Yes,
can
sir.
hear you.
Yes, sir. Thank you so much, sir. And it will be really helpful session for students, as it will help for the students in the last minute revision also. Yes, sir. Thank you so much, sir. Can I end the session, sir?
Okay. Okay. Yeah, thank you. Bye.
Thank you.
Yes, yes. Thank you. Bye. All the best.